Hello friends, welcome to CA Final AFM RTP November 24. Let's start question number 1, which is from portfolio management. It's a very frequent and regular sort of a question which you must have seen in the classes. Two friends, Mr. A and Mr. N, were discussing about the risks of market. While A is risk averse, N is an aggressive investor and believes in taking risk. Students, these lines have not much impact on the overall question. Mr. N said that we cannot diversify the market risk at all, and he quoted the modern portfolio approach. Both friends analyzed the market data for the few months and came out with expected returns on two stocks for particular market. So expected returns mean, students, these are those returns which come with probabilities. These are not historical past returns, these are expected returns. Okay. So then they are saying, based on the above scenario, answer the following questions. What is the beta of the defensive stock? So students, only two information points are there or two data points are there. So we will simply be able to use the formula of delta x upon delta m to find the beta. So can I say delta x? Now if I consider defensive stock to be security x and this is market, can I say delta x is 9, right? 18 minus 9. And delta m, do you realize, is 18, that is 25 minus 7. So can you see that when market moved by 18, this stock is moving by 9. When market moved from 7 to 25, that is by 18%, the stock moved from 9 to 18, that is by 9%. So therefore, do you realize that the beta of this stock comes to 0.5 times. I have written it here. Beta of defensive stock, okay, beta of defensive stock, delta x upon delta m, and that is 0.5 times. So the answer to MCQ point number 1 is 0.5, that is B. Next, they are saying, if the market return is equally likely to be 7 or 25%. Now, equally likely means, do you realize that the probability is given to you for everything is 0.5 and 0.5. So they are asking then, what is the X bar of the aggressive stock, expected return X bar of the aggressive stock? Do you realize we will use the formula of summation Px 4 into 0.5 plus 40 into 0.5. And I hope you realize that comes to 22%. Summation Px, this is the calculation, 22%. So the X bar for point number 2 is point number C, correct? 22%. Next, the alpha of the defensive stock is. Now students, for the purpose of calculating alpha in portfolio management, there is this concept of Sharpe's single index model in which they teach us this equation, that x is equal to beta m plus alpha. Okay, x is equal to beta m plus alpha. Now to find alpha, we take x bar, we take m bar, we take the beta, and we find alpha as the balancing figure. So students, here if you notice the x bar, okay, the x bar, now we are talking of which company? Defensive stock. So for defensive stock, the x bar, do you realize, will be 9 into 0.5 plus 18 into 0.5, and that comes to 13.5. So 13.5 x bar we will place here. Beta we have got 0.5, right? We have just now calculated. M bar, do you realize, similar fashion, 7 into 0.5 plus 25 into 0.5, and that will come to 16. So we have got 13.5, 0.5, 16. We can easily find alpha as the balancing figure. So yes, x bar I have calculated, m bar I have calculated, beta we have already calculated. So students, when we put the numbers in this particular equation, we get the alpha as 5.5, and therefore we have point number 3 answer alpha, that is 5.5%. Okay, next. The modern portfolio theory was propounded by, so students, as everyone knows, it is Harry Markowitz. The entire portfolio management that you study, the first half, is entirely given by Harry Markowitz only. It is given by him. So point number 4, answer is point number D. Now, as per capital market line theory, portfolios lying on the CML over the market portfolio are called. So students, here there was this capital market line. So this is the sigma axis and this is the return axis, and this is how the capital market line looks. Now this is the risk free rate, because at sigma 0 the return that you should get is risk free. Now here there used to be market return, or I might say market risk, sigma m, right, risk. And then when I just plot a line like this, and from here I plot it like this, so this used to be RM, so this is market, okay. Now they are saying that if you are lying on a security somewhere here, okay, if you are lying on a security somewhere here, what are these securities, or I might say portfolios, called as? Now students, please understand this entire line. If you invest entire money in risk-free bonds, you will lie here. This is your return and 0 is the risk. If you put your money half in risk-free and half in market, you will lie on the line between risk-free and market. Now, if you are putting half of your money in risk-free means basically bonds, you are putting money in bonds. Do you people realize you are lending money? Correct? Lending money means, therefore, if you are on a portfolio here, such portfolios are called as lending portfolios. Everyone clear? Because it is here where you decide to lend, right? You decide to give debt, decide to invest in bonds. Students, also, what if you invest 80% of your money in risk-free bonds and 20% of your money in market? Do you realize you will lie somewhere here on this line only, but near IRF? Everyone clear? Because of the weights. If you put 80% of your money in market and 20% in bonds, can I say you will lie here? But the point is, all the portfolios lying on this particular line are all referring to lending portfolios, because somewhere or the other, maybe 20%, 50%, 10%, 90%, 80%, you are lending, correct? So they are called as lending portfolios. But now if you want to lie here, now do you realize this portfolio will give you a return more than market? Correct? The return is more than market, but the risk is also more than market, correct? Now how do you sit here? Any idea how do you sit here? So the capital market line and capital allocation line, all these concepts teach us that to lie here, we need to, let's say if you have 100 rupees, put the entire 100 rupees in the market. Additionally, go and borrow money from risk-free securities. Borrow that money and put again in the market only. By doing that, you create leverage for yourself. Your risk increases, return also increases. Return increases is inter-CA concept that, you know, I have 100 rupees, I put it in market, market is giving me 20% return on my 100. I additionally borrow 50 rupees from outside, let's say at the rate 6%, and I put in market only. Now on that 50 rupees, can I say I'll also get 20%, but from 20 I have to give back 6% to the one from whom I borrowed. So additional 14% do you realize you enjoy? That is called as gearing effect, leverage effect caused by debt, because debt requires fixed return and you are earning more than that. So whatever extra you earn on their money creates magnified returns for you. So if you want to extend your return and risk beyond the market by investing in market only, then you need to do borrowing and investing in the market, and hence this was called as the borrowing portfolios. These parts, these portfolios lying on the line above the market are called as borrowing portfolios. So ideally the answer to point number 5, they are asking the portfolios lying on the CML over the market portfolio. So now students, this word over the market portfolio, they are saying as per the capital market line theory, the portfolio lying on the CML over the market portfolio. Now over, now does it refer to above or on it? That was one confusing point. So if it would have been above the market portfolio, then students, the answer would have been borrowing portfolio. But now over here means, over means on this only. So on the market portfolio if you are lying, then do you realize it is neither a lending nor a borrowing portfolio. It is a market portfolio. Market portfolio means you are taking your money and investing in the market only, in various shares of the market. Hence the answer to point number 5 can neither be lending nor borrowing nor risk free, they will be called as diversified portfolio. Everybody clear? So diversified means you're diversifying in various shares within the market. Okay. So yeah, and also in this particular portfolio, do you realize there is neither any element of you lending in risk free nor borrowing from bonds. It is purely invested in shares. Okay. So with that, students, we complete the discussion to question number 1. Students, question number 2 is a very routine question of mutual funds, nothing great. It's just that they have taken this question and converted it into MCQ questions. So we will discuss the question quickly. They are saying Mr. X on 1/7/21 during the offer of some mutual fund invested 10,000 units having face value rupees 10, which means he must have invested rupees 1 lakh and got 10,000 units. On 31/3/2022, that is, do you realize 9 months later, the dividend paid by the mutual fund was 10%. Now 10% is calculated on the face value. Do you realize you have a face value of 1 lakh rupees? So on 1 lakh, 10% means 10,000 rupees dividend was announced. And Mr. X found that his annualized yield was 153.33%, which is on 31st March 2022. Now students, why did they use the word annualized yield? You should understand that you were not there in this mutual fund as on this date for 1 year. You were there only for 9 months. So in 9 months, the return that you earned, equivalent that to 12 months is 153%. So actually you have not earned 153%. But what you have earned, if it is for 9 months, for 12 months it is equivalent to 153.3%. On 31/12/2023, now this is actually not 31/12, it is 31/3. ICEA has been making this error since long. It is 31/3/2003. 20% dividend was given. On 31/3/2024, X redeemed all his balance units of 11,296.11 when his annualized yield was 73.52. Now students, one thing that comes across is, if you have bought 10,000 units, okay, then how did you redeem 11,296 units? Did you buy some new units in the middle? No. Here it is a hint that the dividends which were given to you were not given to you in the form of cash. They were a dividend reinvestment plan mutual fund scheme, and every time dividend was announced, new units you were getting in the form of dividend. Everyone clear? And how do you get new dividends, or I might say how do you get new units when dividends are announced? The dividends which are given to you are actually not given, but in your name only they are reinvested in the fund on the date on which the dividend is given, and at that time whatever NAV is there, using that NAV they calculate how much units you are supposed to get. So basically for you on 31/3/2022, 10,000 rupees dividend was supposed to be given to you. Now that 10,000 divided by the NAV of that date on 31/3/22, whatever was the NAV, 10,000 rupees divided by NAV they must have done, and additional units you must have received. Secondly, do you realize the additional units you might have received on 31/3/2023 when the second dividend was given? So if you see in this whole question, two dividends are announced. One is on 31/3/2022, one is on 31/3/2023. So please make yourself clear, it was on this very date that your 10,000 units eventually jumped to 11,296. Of course 10,000 jumped to a higher number on this date, and from this date to this date it went on to 11,296. So we have to calculate NAV of 3 dates now: 31/3/2022, 23 and 24. So let us now all focus on the first part, okay, till here, to find the NAV on 31/3/2022. So it's a very simple question. I have taken the help of the X calculations that we do. ICEA has done it in a very shorter approach, but for long-term understanding I use this approach. I will show you my personal solution. Please pay attention. See, first of all, what have I written here? Note, since number of units have auto increased from 10,000 units to 11,296.11 units, it is an indication that this is a dividend reinvestment plan. Okay. Now, calculation of NAV on the first date, that is 31/3/2022. So let's go to the solution quickly. Date of investment 1721. Number of units purchased 10,000 at the rate 10. Investment value 1 lakh, that is 10,000 into 10. Now comes 9 months later, 31/3/22, on which date you have to calculate the NAV. The dividend given to you or supposedly given to you was rupees 10,000. Let the NAV on that date be X. So do you realize on dividend reinvestment, the new units you will receive is 10,000 rupees divided by X. So the total units that will be there with you will be 10,000 units that you already had plus these additional units, correct? Original units plus the dividend reinvestment units. And that if you just calculate, it comes to 10,000x plus 10,000 the whole divided by x. Now, what will be the value of your investment on 31/3/2022? It will be number of units multiplied by the NAV. Everybody clear? So number of units you had were these. This when you multiply by the NAV, that will give you the value of your investment. And when you just open this up, it comes to 10,000x plus 10,000. So students, why are we calculating the value of investment? Because they have told you that your annualized return is 153.3%. Now you are staying in this fund only for 9 months, but your annualized return is 153.3. So everyone knows, right, in annualized yield, the calculation that we do will be the total value of your investment minus the investment value upon investment value into 12 by M into 100, right? Some of you might have the doubt, why am I not adding the dividends? The dividends are not getting added in the formula because they are reinvested and this is reflected in the overall value of your investment on the last day. So 153.33, that is the annualized yield, is equal to, now students, total NAV1 at the end of the year, can I say is 10,000x plus 10,000 minus investment value 1 lakh divided by 1 lakh into 12 by 9 into 100. When you solve this, you get x as 20.5. So your NAV on 31/3/22 is 20.5. Once you get x, do you realize you'll also be able to know how many new units you received? 10,000 rupees dividend at the rate 20.5 NAV, can I say new units you must have received is 487.8, and the total units therefore on 31/3/22 is 10,487.8. Now I hope you all are alert that from 10,487.8 to 11,296.11, do you realize that jump will happen on this date when the second dividend is given. So students, next they are asking you, so by the way, I hope you realize that we have calculated the NAV on 31/3/2022. Now they are saying on 31/3/2023, 20% further dividend was given. Now please note, this 20% dividend will be given on the face value that you have. The face value that you have, do you realize, is 10,487.8 into 10, right? You have extra units now. This face value into 20% will be the new dividend that you will get. Now let the NAV on 31/3/23 be X, and can I say at this rate you will be receiving new dividends, or I might say new units on dividend reinvestment on 31/3/2023. Now I hope everybody understands that these new units that you will get will take your number of units from 10,487 to 11,296. This is what we have already discussed, which means the additional 808.31, correct? The additional 808.31 units that you will be getting, right, is exactly what this equation is all about, because we know that 20,976 was the dividend that I was supposed to get. That divided by the NAV on that date must have given me these additional units. So which when I equate, I get the value of X, that is the NAV on 31/3/23 as 25.95. Everyone clear? So with that we complete the discussion to NAV on 31/3/2023. Next students, we go on to 31/3/2024. He is saying I redeemed all my units and at that time my annualized yield was 73.52. So now students, please understand, annualized doesn't mean the return of this 23/24 year only. No. Annualized means my return from this date to this date, effective for 12 months. Now see, from 1/7/23 to 31/3/24, it is a total of 33 months. Okay. So over 33 months, how much return I earned? equivalent for 12 months is this 73.52, annualized it is, okay. So how do we calculate it? Very simple. So calculation of NAV on 31/3/2024. So as you know, my investment was 1 lakh. Over 33 months, can I say it grew to 11,296.11 units into NAV on that date. This will be the value of my investment on the last date. If I consider NAV on 31/3/24 to be X, do you realize this is the value of my investment on the last date? This is my investment value. Over 33 months, it grew to this. So can I say this gave me an annualized return of 73.52. So can I say 73.52, the annualized return is equal to value of my investment on the last day minus investment value upon investment value into 100 into 12/33, because this particular return that I am marking here is over 33 months, but this 73.52 is equivalent for only 12 months. Hence we are annualizing it. When we solve it, we get X as 26.75. Now that we have cracked the question, let's see what MCQs they are asking. They are asking what is the NAV of the fund on 31/3/22. The first NAV we found, that was 20.5. Total number of units on 31/3/22. I hope you remember 10,000 units plus 487 extra, you got 10,487. Total dividend received by Mr. X on the second date, we have got 20,976. It is basically 20,976 only, this same number. Then students, they are asking you what is the NAV on the second date. That also we cracked, 25.95. And then NAV on the last date, students, we just now got 26.75, this number, okay. So with that, students, we complete the discussion to question number 2. Now students, let us go to question number 3. Now onwards, no MCQs, normal questions are there. So question 3, students, belongs to derivatives chapter. Let's try understanding. Mr. X is holding 100 shares of V Limited, which is being quoted at 2,100 per share. This, do you realize, is your S0 spot price. He is interested in hedging downside risk of his holding as he is going to sell after 2 months. So please understand, Mr. H here is not worried about future buying of a share. Mr. H already owns the share. He is worried about future selling of the share. He is afraid, what if the share price goes down? A 2-month call option is available and a 2-month put option is available. So students, which option do you think we should go for, call option or put option? Of course, we should go for a put option. Why? Because students, you already have the share. Your risk lies in future selling of the share, and which option gives you a right to sell? Put option, right? And what is this 50? 50, do you realize, is the premium that you have to pay for the put option. The strike price, which some people call it as X, some people call it as K, in both cases is 2,200, which means if you buy a put option today at the rate rupees 50, it gives you a right to sell the share at 2,200, correct? Now let's understand the basics of put option. If on due date the spot price, that is S1, goes about 2,200, if S1 is greater than your strike price, greater than X or greater than K, do you realize the put option is useless? You will lapse it, because why would you want to exercise your right to sell the share at 2,200 when in the market the S1 is above 2,200? Similarly, on the other side, if S1 is less than 2,200, oh yes, then your put becomes valuable. Do you realize you will exercise your right to sell at 2,200? Which means when S1 is below K, the put is in the money, you should exercise it. When the S1 is above K, the put is out of money, you should lapse it. Point number 1, suggest the position Mr. H should take in the option market to hedge his holding. As we discussed, the position he should take is he should go for a put option. Now students, he is holding 100 shares. Now do you realize if it is 50 per share, the total premium that he has to pay will be rupees 5,000. So I'll just show you the solution. So since we want to hedge future selling of shares, we should buy a put option with a strike price of 2,200. Total premium paid will be rupees 5,000. Next, what are they asking you? They are asking you, calculate his final position if after 2 months, that is on the due date, the S1 happens to be this, this or this. Now students, do you all understand they have given to you 5 different cases of what S1 could be? Do you realize if S1 is 2000, 2100, these two are where the put is in the money. So you will not sell your share at these rates. You will of course sell your share at the strike price because you have a right to sell it at 2200. If it is 2300 and 2400 where S1 is above K, the put is out of money, can I say you will lapse your right and sell it outside at 2400? And can I say at 2200 put is at the money, S1 is equal to K. Now, whether you exercise or you sell it outside doesn't matter. Do you realize you will of course get 2200 only? We will say you lapse it and sell it outside. Okay. So do you therefore realize that you are getting minimum price of 2200 or above, correct? So I'll just show you the solution. Of course, do you also realize that these are your gross selling prices? From this, do you realize I'll have to subtract the premium that I have paid irrespective of S1? Premium I'm paying today only, and that should give you your net selling price. So I have made this table. So S1 all different ranges I have taken. K, of course, that is the strike price I have kept fixed 2200. Status, as we discussed, first two in the money, last two out of money, center one is at the money. So the sale price, wherever it is in the money, it will be K. Wherever it is out of money, it will be S1. And wherever it is at the money, K or S1 doesn't matter. Minus the premium paid will give you the net profit. And then that net profit, do you realize, is on the basis of single share multiplied by 100 shares will give you the total net profit. Thus, from the above table, it can be observed in any case the value of the holding of Mr. H in V Limited shall not go below 2150 per share. Actually 2200, but considering 50 rupees premium, 2150. Everyone clear with this? So with that we complete the discussion to question number 3. So now let's do question number 4. Students, question number 4 is actually not from derivatives. It is being put here in derivatives, but it is actually from the chapter of portfolio management. Now in portfolio management, there is one section in the module called as portfolio rebalancing. In portfolio rebalancing, they have given 3 techniques of how one can manage your portfolio. One technique is called as the buy and hold strategy. One is called as the constant mix or the constant ratio policy. And one is this CPPI, constant proportion portfolio insurance policy, on the basis of which this sum has been asked. So what I will now do is, I will first of all pull out one video from my course on AFM in which I have in detail explained this entire portfolio rebalancing. In that video, I have also taken up one full-fledged question which is a replica of this question, okay? Nothing new, only numbers have changed here, otherwise everything is same. So I want you to watch it right now in couple of minutes, or I might say in 1 minute it will start now, here only. But once you are done with that, then you should pause the video and then try solving this entire question on your own, okay? I have already written the entire solution down. I will be attaching this PDF in this very YouTube video. You can then take that PDF and tally your answers. Please trust me, after you have seen my explanation to CPPI and the entire solution of the similar question which is there like this, you should be able to crack this on your own. So now please watch my video, portfolio rebalancing. So welcome to this new module called as portfolio rebalancing. Students, in this video, I will be explaining to you the theory of this particular concept, and in the next video, I will be doing one sum that has come in the examination based on this concept. Students, it is best if we go through this theory part from the institute's new study material itself. So the new study material is there in front of you now. Let us start, okay? So portfolio rebalancing. Let's read paragraph by paragraph and I'll keep explaining it to you, okay? Let's start. Students, first of all, I would request you all to pause the video and read from here to here only. Start. Okay students, so I hope you all have read it. Let me read it now and I'll explain whatever is necessary from that, okay? Portfolio rebalancing. It means the value of portfolio as well as its composition. The relative proportion of bond and stocks may change as stocks and bond fluctuate in response to such changes. Portfolio rebalancing is necessary. There are three policies of portfolio rebalancing: buy and hold policy, constant mix policy, constant proportion portfolio insurance policy. These policies have different payoff under varying market conditions. Under all these policies, portfolio consists of investment in stock and bonds. So what they are saying, students, very simple. What they are saying is that this is your portfolio, okay? This is your portfolio. Your portfolio will consist of equity as well as debenture or bonds component. Students, as the market varies up down it goes, there is a need for you to keep rebalancing the proportion of equity and bonds within your portfolio, okay? That is the whole thing that is given in this first paragraph, nothing else, which means they are saying that yes, you will create a portfolio of equity and bonds, but because the markets will fluctuate, your portfolio values will fluctuate, and as the portfolio values fluctuate, it is a necessity that you keep re-looking into your composition of the portfolio, the value of the portfolio, and keep adjusting the structure of it, keep adjusting the proportion of equity and bond in it, okay? And to do that, they are saying that there are three policies available, or three methods available. The first method is buy and hold policy, the second one is constant mix, and the third one is CPPI, okay? So let's now try understanding each one of them. Students, now what I am doing is asking you to pause the video here and read this buy and hold policy starting from here and ending here, okay? Starting from there, ending here. So what I will do is I will first keep the screen here, pause the video and read this much first. Okay students, I hope you all read this. Now students, you can pause the video and read this part here. Start. Okay students, so I hope you all have read this. Let us now try understanding buy and hold. I'm very sure you understood, very simple language given, okay? Buy and hold policy. Sometimes this policy is also called as do nothing policy. As under this strategy, actually there is no rebalancing happening. No balancing is required and therefore investor maintains an exposure to stocks and therefore linearly related to the value of stock in general. Under this strategy, investors set a limit, that is floor, below which he does not wish the value of the portfolio should go. Therefore, he invests an amount equal to floor value in non-fluctuating assets bonds. Since the value of portfolio is linearly related to the value of stocks, the payoff diagram is a straight line. This can be better understood with the help of an example. So before I take an example, I will just explain till whatever I have read here. See, what he says is, this is your portfolio consisting of equity and bonds. And now, whatever the portfolio value is there, he says he doesn't want his portfolio value to go below a limit. And that limit he calls as the floor. Floor, why do we call it as floor? Students, if I take you to the ceiling of your house and you drop you down, if you drop, the maximum you can drop is the floor, right? Therefore, that floor is therefore called to be the minimum value of portfolio that he can tolerate. Below that, he doesn't want his portfolio's value to go. So what he does, he therefore creates his own floor and says this much part he will invest in bonds and the other part he will invest in equity, so that even if the equity wipes off, his portfolio value will at least be minimum the bond value, correct? Which means basically total he wants to put 1 lakh. Okay, let's say total he wants to put 1 lakh. Students, in 1 lakh he says I do not want my portfolio value to go below 20,000. So okay, 20,000 he will invest in bonds, 80,000 he will invest in equity. Whatever happens in the equity share, his portfolio value will minimum be 20,000 assuming the bonds are non-fluctuating, correct? Students, therefore, do you realize that considering the bonds to be fixed 20,000, whatever will happen in the equity. If this portfolio has to go up, it will go in relation to the equity going up. If this portfolio has to go down, it will go down in relation with the equity going down. Therefore, we say that the portfolio has a linear relationship with the equity because bond is a fixed component. It will not change. Yes. So now reading ahead. Okay students, now let's read ahead. They are giving you an example. Suppose a portfolio consisting of debt bonds for 50,000 and 50,000 in equity shares, which means he has kept 50-50, currently priced at rupees 100 per share. So they are saying that this 50,000 that they have invested in shares, one share market value is rupees 100. If the price of the share moves from 100 to 200, it doubles. The value of portfolio shall become 1,50,000. Wait, how 1,50,000? Students, very simple. See, his portfolio earlier had 50-50 component, right? Students, he had put 50,000 here, he had put 50,000 here, correct? Now what happens is the price of the share goes from 100 to 200, which means the price of the share doubles. And if the price of the share doubles, do you realize this equity which was currently 50,000 will now straight away go to 1 lakh. Therefore, earlier your portfolio value which was earlier 50 plus 50, that is 1 lakh, will now go to 1.5 lakh. That is what they are saying here, correct? Let's now read ahead. The payoff diagram is shown in the figure below, that is a straight line. So can you see, when the value of the share price is 0, the value of your portfolio is 50,000 obviously, because only bonds will be there, correct? Equity's value is 0. When the price is 100, do you realize that equity also now becomes 50,000 and therefore the total value becomes 1 lakh. So this is that coordinate. When it goes to 200, the total portfolio's value will go to 1,50,000, that is 50,000 plus 1 lakh in the equity. This is the coordinate, and therefore the line we have seen sharp single index model. There is nothing for me to explain here. Of course, the graph is not as per sharp single index model, but graph presentation at least you know, correct? So students, this therefore is a straight line, a linear line. Why it is a linear line, students? Because the portfolio's value straight away moves in tandem with the share price. Yes? Okay. So now let's read ahead. This policy is suitable for the investor whose risk tolerance is positively related to portfolio and stock market return but drops to 0 of below floor value, which means he says he has got risk tolerance, but his risk tolerance becomes 0 the moment the portfolio touches floor value, which means floor value below that he has no tolerance of accepting the fact that his portfolio's value will go below floor. Till it hits the floor value, his risk tolerance is there. Okay. Concluding, it can be said that following are the main features of this policy. Point number A, the value of portfolio is positively related and linearly dependent on the value of the stock. Of course, it is positively related means our correlation coefficient of the portfolio's value with the share price obviously is positive. As the share price increases, portfolio value will also increase. And of course, the R must be +1 since the coordinates are not scattered, they are on a straight line. Okay, next. Point number B, the value of the portfolio cannot fall below the floor value, that is investment in bonds, obviously, correct? And point number C, this policy performs better if initial percentage is higher in stocks and the stocks outperform the bond. Obviously, if your floor value is very low, let's say out of 1 lakh rupees, you have kept only 10,000 as the floor value initially and 90,000 is there in equity, and then the equity outperforms, then that portfolio, such a buy and hold strategy will work brilliantly for you. Reverse will happen if the stock underperforms in comparison of prices. Basically, their prices go down. Students, what does that mean? That means that if in this case you have kept only 10,000 in bonds and 90,000 in equity, and if the share prices fall, then to that extent you will face huge losses. Okay, that was point number C. Students, with that we complete the buy and hold strategy. Okay students, so we now go to the policy number B, constant mix policy. So before I explain it, students, please pause the video and read what you see on the screen from year to year. Start. Okay students, I hope you all read this. Now students, I will show you the graph. Okay, Yes, you can now again pause the video and read this particular section that is there on your screens. Yes, so I hope you all read this. Now the last point, students. Yes, so now students, the second last point I will show you. Please read from year to year. Look at each number carefully. Okay students, I hope you all read this. And now the last part here. Yes, you can pause the video and read from year to year. Okay students, so I hope you all read this. Let us now try understanding this, okay? Constant mix policy. Contrary to the above policy, okay, this policy is a do something policy. Under this policy, investor maintains an exposure to stock at a constant percentage of total portfolio. This strategy involves periodic rebalancing to required desired proportion by purchasing and selling stocks as and when their prices go up and down respectively. In other words, this plan specifies that the value of aggressive portfolio to the value of conservative portfolio will be held constant at a predetermined ratio. However, it is important to this action is taken only if there is a change in the prices of a share at a predetermined percentage. Okay, see, let me explain this to you. Now, this is your portfolio. Students, equity and bonds. Now, they call the equity portfolio as an aggressive portfolio, obviously, and bond will be a conservative portfolio. Students, let's say you have put 10 rupees in the equity, you have put 10 rupees in the bonds, total money you have put is 20. What is the weight of equity and bond? Can you see it is 0.5 is to 0.5, correct? So 50-50 you have invested in equity and bond. Students, let's say now due to market fluctuations, your equity 10 rupees drops down to 8. Due to that, your portfolio will drop down to 18. What this method says is constant mix means it says that you should now rebalance your portfolio so as to ensure that the original proportion of debt and equity remains constant. Now, for us to ensure that the proportion of debt and equity remains constant, which means 50% equity, 50% debt, do you realize currently it is not so? Currently, out of 18, 50-50 is not distributed amongst bond and equity, but this particular policy says distributed 50-50, which means to distribute it 50-50, do you realize that my equity should go up to 9 and my bond should go down to 9. Everybody following? Which means again I'll repeat, earlier it was 10, 10 and 20, correct? 50% was in equity, 50% was in bonds, 20 was the total portfolio. Then let's say this 10 goes down to 8, okay? 10 goes down to 8. What will the portfolio value go down to? 18. See, this will not change because they are bonds, they are fixed, correct? Now 18 is the value of your portfolio and this 18 should now be distributed 50-50 amongst bond and equity because they want your proportion between bond and equity to be constant. To do that, do you realize 9 should be in equity, 9 should be in bonds? To do that, what to do? We will have to sell off 1 rupee in bond portfolio, bring it down to 9, and that one you should invest in equity portfolio, bring it up to 9, correct? Students, this is what it means by the first paragraph here in the constant mix portfolio. Also students, do you see that your equity had gone down from 10 to 8, which means it had gone down by 20%, correct? Students, sometimes this particular policy says that this 20%, if it is not good enough, which means according to them, a good enough change, let's say is 30%. So they will not rebalance the portfolio till the time there is a 30% hit, either downwards or upwards. If a 20% hit has only happened, they will say let it be, let it continue to remain at 8, 10 and 18. Don't rebalance because the 20% change is very low. If it is 30% change, then there is a problem. Like that, the question will specify what is good enough percentage hit for you. So I'll again read this. See, this strategy involves periodic rebalancing to required or desired proportion by purchasing and selling stocks as and when their prices go up and down respectively. In other words, this plan specifies that value of aggressive portfolio to the value of conservative portfolio, which means the ratio of equity to bonds will be held constant at a predetermined ratio. In my example, it was 0.5. However, it is important to this action is taken only if there is a change in the prices of a share at a predetermined percentage, which we took here as 30. If they are saying that 30%, till 30, if there is any change, don't even bother of rebalancing. 30 and above, immediately rebalance. I hope you understood. Okay. So now let us read ahead, students. For example, if an investor decided his portfolio shall consist of 60% in equity shares and balance 40% in bonds, which means he's saying 0.6 and 0.4. Yes, 60% in equity, 40% in bonds is his fixed proportion of equity and bonds. On upward or downward of 10% in share prices, he will strike a balance, which means he's saying that if the prices move by 10% up or down, then only he will rebalance the portfolio. If the prices move up and down by 5%, 7%, etc., he will not rebalance. Okay. In such situation, if the price of the share goes down by 10% or more, he will sell the bonds and invest money in equities so that the proportion amongst the portfolio 60-40 remains the same. That is what we did here, right? When the price of the equity went down, we immediately sold something from the bonds and invested in equity to maintain the balance. If the price of the share goes up, then opposite will happen, correct? He will sell equity shares because now the equities proportion must have risen and shall invest in the bond so that the ratio remains same, that is 60-40. This strategy is suitable for the investors whose tolerance varies proportionately with the level of wealth, and such investor holds equity at all levels. Do you realize what this line means? It means that his floor value now will keep changing based on the equity, correct? Because he wants that 40% of the total portfolio should be the floor value. I hope you understood what I said. 40% of the total portfolio value should be the floor value because that is what he wants to keep in the bonds. Unlike the previous method where the floor value was fixed amount, 2,70,000. Here they say the floor value is a fixed percentage, that is 40%. The payoff of this diagram shall appear as follows. So students, if you do a diagram, it will appear a curve like this. It is not much important to go into the details here. Let us read forward. Accordingly, it gives a concave payoff, tends to do well in flat but fluctuating markets. Students, there is an example here. Continuing the above example, let us understand how investor shall rebalance his portfolio under different economic conditions. Okay. So students, this is an example. What is the share price? 100. He has invested 50,000 in shares and 50,000 in bonds. Total value of the portfolio is 1 lakh. The moment the share price touches 80, do you realize the value of the shares will go to 40? That is 50,000 divided by 100, that is number of shares, into 80 will give value of shares, that is 40,000. And the value of the bonds obviously will continue to remain 50,000. So the total value, students, now becomes 90. That is 40 plus 50, that is 90. Students, tell me, if he wants to keep 50-50 in equity and bonds, do you realize after rebalancing 50% means, students, from 90,000, 45,000 should be in equity, 45,000 should be in bonds. That is total of 90,000. I hope you understood. Very simple. But to do this, what you have to do, you will have to bring this 50 down to 45, which means from the bond portfolio, you will have to sell 5,000 bonds and invest in shares to bring it up from 40 to 45. Now students, let's read ahead. So now from 80, if it drops to 60, if the share price drops to 60, students, do you realize your 45,000 will drop to 33,750? Basic cross multiplication, correct? Bond valuation is 45,000, continues to remain 45. Total value is 78,750. Students, 78,750, do you understand, has now to be bifurcated 50-50 in bonds and equity. So 78,750 divided by 2, if you do, that is multiplied by 0.5, you get 39,375. Students, what is the price of one share? 60. So 39,375 divided by 60, you get 656. Okay, 656.25 number of shares. Which means, students, if now this has to be bifurcated 50-50, the number of shares that you should have in the equity is 656.25, correct? And then the value obviously will be 39,375, and this obviously will be the other half, 39,375, and total will be 78,750. But students, this 0.25 shares will not be available outside. So what we will do is we will only take 656 shares. Okay. So if we take 656 shares and multiply by the price, that is 60, what we get is 39,360, correct? And this 78,750 minus 39,360 will give the balance of 39,390, and this is how we will now be rebalancing the portfolio. Yes, and 39,390 means what, students? From 45,000, 5,610 rupees bond you'll have to sell, bring it down to this amount, and then invest that 5610 in the equity portfolio to bring it up to 39,360, correct? Students, with this we understand how to rebalance a portfolio. Of course, this is not exactly 0.5, but practically speaking, considering the number of shares, this is as good as 0.5. Yes. Now students, I would request you all to pause the video and on your own now understand this part. There is nothing for me left to be explained. Complete understanding this. I know you have read it, but please once more pause it and go through this particular part carefully. Yes, students. So now let's go and understand the last policy, that is constant proportion insurance policy. Students, I would request everyone to right now pause the video and read it from year to year. Okay, students, I hope you all read this. Let us now go to the next one. Students, I request you all to kindly read from year to year. Okay, students, I hope you all read it. Now I would request you all to kindly read from year to year. Okay, students, I hope you all read this, and with that we complete the reading of CPPI. Very simple. In fact, this particular policy we can understand very easily through an example. Still, I will read it once for you. Okay. Under this strategy, investor sets a floor below which he does not wish his asset to fall, called floor, which is invested in some non-fluctuating assets such as treasury bills, bonds, etc. The value of the portfolio under this strategy shall not fall below this specified floor under normal market conditions. This strategy performs well, especially in bull market, as the value of the shares purchased as cushion increases. In contrast, in bearish market, losses are avoided by sale of shares. It should, however, be noted that this strategy performs very poorly in the market hurt by sharp reversals. The following equation is used to determine equity allocation. So they are saying investment in equity shares should be equal to portfolio value minus floor value into multiplier. Very simple it is, please pay attention. Multiplier is a fixed constant whose value shall be more than 1. Why? I'll tell it to you in some time by the example. The payoff under this strategy can be understood better with the help of an example even they are saying. Okay. Suppose wealth of Mr. A is rupees 10 lakhs. Floor value is 750. Stop. What does that mean? He has rupees 10 lakh. He wants to invest in a portfolio, but he wants to ensure that the value of the portfolio doesn't drop below 7,50,000 and a multiplier of 2. What is this? I'll tell in some time. Since the initial cushion, that is difference between portfolio value and floor value, is 2,50,000, from where 2,50,000 came, students? This year. Can you see portfolio value is 10 lakhs and the floor value is 7.5 lakhs. So basically this is a cushion of 2.5 lakhs. The initial investment in the share shall be 5 lakh, double of the initial cushion. Why double? Because they are saying, right, multiplier should be 2. So investment in shares will be multiplier into portfolio value minus floor value. 2 into 2.5 lakh, that is 5 lakh. That means out of 10 lakhs, 5 lakhs he will invest in equity and 5 lakhs he'll invest in debt. Students, his floor value was 750. He should have invested 750 in the bonds according to the previous policies. So he's saying that considering multiplier of 2, I want to take some risk. Instead of investing 7.5 lakh in safe, he is investing only 5 lakh in safe and 5 lakh in risky. Yes, so that is the meaning of multiplier. Students, do you realize that if the multiplier was 1, okay, if I write 1 year, then it is 2.5 lakh into 1. The portfolio would have appeared like this: 2.5 lakh in equity and 7.5 lakh in debt, correct? Completely safe. 7.5 lakh is safe and 2.5 lakh you invest in the equity. Students, do you realize therefore the more the multiplier is there, the more risk you are ready to take. When the multiplier went to 2, the portfolio is like this now, 5 lakh in equity and 5 lakh in debt. Had the portfolio multiplier been 3, students, if it was 3, do you realize 7.5 lakh would have been in equity, only 2.5 lakh would have been in debt. Therefore, do you also realize as the multiplier increases, the risk appetite increases, but of course this cannot go below 1. Why it cannot go below 1, students? Because if it goes below 1, you are breaching your cushion, which means if I say this is, let's say 0.5, so it was 10 lakh minus 7.5 lakh into 0.5. What does that mean? 2.5 lakh into 0.5 is only 1.25 lakh. Your portfolio will be only 1.25 lakh in equity and the balance 8.75 lakh in debt. This much floor you don't want, correct? You want floor of only 7.5 lakh. So the minimum multiplier has to be 1, correct? So that the floor at least is 7.5. Then if you want to take more and more risk, the multiplier will keep increasing. I hope you understood, yes? Next they are saying accordingly initial portfolio mix shall be consisted of 5 lakh equity and balance 5 lakh in debt, that is bonds. Situation 1. Suppose the stock market increases from 100 to 150. The value of the shares of Mr. A's holding shall rise from 5 lakh to 7 lakh 50. Stop. How? Students, see. Earlier it was 5 lakh equity, 5 lakh debt, correct? Now do you realize the equity is experiencing 50% rise? 50% rise means 5 lakh plus 50% will obviously be 7 lakh 50. So do you realize now that my portfolio will appear something like this. This will continue to be 5 lakh. This will be 7.5 lakh. Total portfolio will now be 12.5 lakh, correct? So equity has gone from 5 to 7.5, 50% jump, considering a 50% jump in equity, and the value of debt will continue to remain same, that is 5 lakh. Therefore your portfolio value now is 12.5. Students, immediately tell me what should be the investment in equity? It should be portfolio value minus floor value into the multiplier. Students, your floor value here is how much? Your floor value here, if you remember, was 7 lakh 50,000, correct? So students, your portfolio value now is 12.5 lakh minus 7.5 lakh, the whole into multiplier. Students, 12.5 minus 7.5 is 5 lakh into 2 is 10 lakh. Therefore your investment in equity, students, should be 10 lakh. Investment in equity should be 10 lakh out of 12.5 lakh, which means your portfolio should appear like this. 12.5 lakh is your total value of portfolio. In that 10 lakh should be equity, 2.5 lakh should be the debt. 2.5 lakh should be the debt. Can you see this here? See. They are saying situation 1, if the price goes from 100 to 150, value of Mr. A's holding will go from 5 lakh to 750 and the value of portfolio shall jump to 12.5 lakhs and the value of the cushion to 7.5 lakhs. Since the CPPI policy requires the components of shares to go up to 10 lakhs, this will necessitate the selling of bonds amounting to 2.5 lakh and reinvesting the proceeds in shares. Yes, you can see here from bonds I sold 2.5 lakh so that it went down to 2.5 and invested those proceeds in equity, which went up from 7.5 to 10 lakhs. Yes. So now with that, students, now I would request everyone to read situation 2 and understand what they have done. Very simple. There is nothing for me to explain here. Please pause the video and try it. Yes. So if they are saying the stock market falls from 100 to 80, that means a 20% fall, correct? Students, earlier it was 5 lakh equity, 5 lakh debt. Okay. So I'll write down here 5 lakh equity, 5 lakh debt. Now if the equity drops by 20%, do you realize the revised portfolio will be, your equity will go down to 4 lakh. That is 5 lakh minus 20%. Bond will continue to remain 5 lakh, correct? Debt will continue to remain 5 lakh. Total will be 9 lakh. Students, tell me what should be the investment in equity? It should be portfolio value minus floor value into the multiplier. 1.5 into 2, value of equity should be 3 lakhs. Value of equity should be 3 lakhs. Therefore, students, can you see that the value of equity in your portfolio should be worth 3 lakhs? total portfolio is worth 9 lakh. For this to go to 3 lakhs, do you realize you'll have to sell your equity shares worth 1 lakh, and therefore it goes down to 3 lakh of equity, and that 1 lakh that you got, you have to put in portfolio of bonds, which will go up to 6 lakh, correct? Bond or debt, whatever. Yes, so that is what they are saying. As per CPPI, the share component should be 3 lakhs. Students, I hope you understood CPPI also. Yes, so students, I would request everyone now to just open your new study materials here and again go through these three policies. Tell me, the first policy was what? Buy and hold strategy, correct? In buy and hold strategy, what do? You have a fixed floor. That money you put in bonds and the remaining you play in equity and do nothing about it ever after, correct? Then comes constant mix. In constant mix, what happens? The proportion of bond and equity will always remain fixed. Basically, your floor will always be a fixed percentage of your total portfolio value. And in the CPPI, what you do, you are playing now, you're taking a bit of risk here, where you say that my value of equity should be equal to the portfolio value minus the floor value. Students, obviously, do you realize that in your first model, that is buy and hold strategy, portfolio value minus floor value is the value of equity, game over. That is the question. But here they say portfolio value minus floor value into a multiplier. So if you do not want to take any risk, your multiplier will be 1. So portfolio value minus floor value will go in equity and the floor value will be purely in bonds. But if the multiplier is now 2, 3, etc., do you realize you're now taking risks and the value of your equity will now swell above the cushion and your floor value, which should have been high, goes down and you're investing now less amount in bonds because you want to take some risk. Yes, if you don't want to take any risk, then your multiplier should be 1. Your entire money in bonds should be equivalent to the floor value and the balance should be equity. But the moment a multiplier comes into picture, I hope you understand that the situations change. You're taking slightly more risk. Okay, students, so with this I end this video here. As far as the notes are concerned, students, I'm not going to give you any separate notes because these notes in the ICAI study material, new study material, are good enough. This is the portfolio theory study material, portfolio management study material, new syllabus. Yes, portfolio rebalancing is the concept. These are the notes which are relevant for this particular video. In the next video, students, I will be doing one sum that has come in the examination based on this concept, especially the CPPI concept was asked. We will see that particular question. So let's now do one question which is there in this old practice manual of Indian capital market based on what we saw in the previous video. It also is there in the new RTP May 19. In May 2012 paper it came for 8 marks. And yes, you can see this constant proportion portfolio insurance policy. Yes, basically it is dependent on the third variant we saw in the last video. The third part, where we used to determine the portfolio based on the multiplier and the floor value. Can we start? Alright. Indira has a fund of rupees 3 lakhs which she wants to invest in share market with rebalancing target after every 10 days to start with for a period of 1 month from now. The present Nifty is 5326 points. The minimum Nifty within a month can at most be 4793.4. She wants to know as to how she should rebalance her portfolio under the following situations according to CPPIP using 2 as the multiplier. Point number 1, immediately to start with, and point number 2, 10 days later being the first day of rebalancing if Nifty falls to 5122.96. Third, 10 days further from the above data if the Nifty touches 5539.04. For the sake of simplicity, assume that the value of her equity component will change in tandem with that of Nifty and the risk-free securities in which she is going to invest will have no beta. Okay, so students, please pay attention here. See, what does she have? She has rupees 3 lakhs, correct, which she wants to invest in this portfolio. She is saying that the present Nifty is 5326 and the max it can fall down to is 4793.4. Students, they are saying that for the sake of simplicity, assume that the value of the equity component will change in tandem with that of Nifty, which means if Nifty falls, your portfolio will accordingly fall. If Nifty rises, your portfolio will accordingly rise. Students, what is she saying? That the maximum fall that can happen is 4793 0.4. So students, do you realize that if 5326 is the present value, I'll write down here question number 84. Okay, 5326 is present value of Nifty. It is saying it can max fall to 4793.4. So I'll write down here minus 4793.4 is the max she perceives, divided by 5326 if we do into 100, that is 5326 minus 4793.4 divided by 5326 into 100 will give me 10%, which means she's saying that the equity component can max drop by 10%. Yes, it can max drop by 10%. Students, what amount does she have? She has 3 lakhs. She wants to put this 3 lakh in the equity market. Do you realize that the floor value, according to her, floor value will be 3 lakhs? Okay, now if this equity moves in tandem with the Nifty, do you realize the floor value max she perceives is 2,70,000? Okay, that means according to her, she's saying that if she puts the entire 3 lakh rupees in the equity market, then that equity market which is running in tandem with Nifty, if it can max fall by 10%, equity portfolio will also max fall by 10%. Therefore, she is perceiving that her floor value has to be 2,70,000. Till here you understood. Now let us calculate how much she should invest in equity. She is saying that she wants to use 2 as a multiplier. I am very sure you know what to do now. So I'll write down here investment in equity will be equal to, okay, investment in equity will be equal to portfolio value minus floor value, the whole into multiplier, correct? She has 3 lakh rupees with her. The floor value is 2.7 lakh into multiplier, that is 2. That is 30,000 into 2, that is 60,000. So students, her portfolio, okay, today her portfolio will be equity shares will be worth 60,000 and risk-free assets, that is debt etc., will be worth the balancing, that is 2,40,000, and her total portfolio value obviously is 3 lakhs. Yes, so with this students we complete this point number 1. What should be her portfolio immediately to start with? Now the rebalancing will start as the equity market fluctuates. She says that 10 days later, being the first day of rebalancing, the Nifty falls to 5122.96. Okay, 5122.96. Students, see, 5122.96 is now the value of Nifty. Students, what was your equity portfolio worth? 60,000, right? So your equity was worth 60,000 when the Nifty was 5326, correct? When the Nifty was 5326. So when the Nifty was 5326, your equity's value was 60,000. When the Nifty drops to 5122.96, your equity value will be how much? Let's take the calcs. 60,000 into 5122.96 divided by 5326, that will give me 57713. Yes, 57,713 will become my equity value. Students, do you now realize that your portfolio will now appear something like this? It has equity, it has risk-free, and this is the total portfolio. Students, equity which was earlier 60,000 now drops to 57,713. Your risk-free assets will continue to remain 2,40,000. So I'll write down here 2,40,000, and the total will now be plus 2,40,000 if I do, that is 2,97,713. Students, how should I rebalance now? Do you realize the equity component has to be, remember the formula? The equity component has to be portfolio value, okay? I'll write down here portfolio value minus floor value into multiplier. Students, the portfolio value is 297,713. Floor value is how much? 2,70,000, the whole into 2, correct? The whole into 2. So therefore, if I take my calc, 297,713 minus 2,70,000 into 2 the equity component should be 55,426. So I'll write down here 55,426. Total portfolio value obviously cannot exceed 297,713. Therefore, the amount you should invest in risk-free assets should be 2,42,287. 242,287. Basically what you are doing is, see on your calcs, 57,713 minus 55,426. 2287. Yes, 2287 from equity you will sell off and you will invest in the risk-free assets, thereby making this new portfolio appear like this. Yes, so students, I hope you understood this particular calculation. 55,426. Yes, let us now go to point number C, that is point number 3. The last point, students, they are saying 10 days further from the above data, if the Nifty touches 5539.04, I'll write down here 5539.04, correct? Then how should you rebalance? That is the question, correct? Students, if the Nifty touches 5539.04, do you realize the equity component will now undergo a change? Your current equity component is how much, children? It is 55,426. So I'll write down here 55,426 is the value of equity when the Nifty is, students, 5122.96. So I'll write down here 5122.96. So if it touches 5539.04, what should be the equity component now? Can we start? Yes, 55,426 into 5539.04 divided by 5122.96 will give me 59,928. 59,928. Yes. Now let's see how the portfolio appears. Your equity component, debt component, total portfolio. Students, the debt component, that is the risk-free component, will continue to remain 242,287. Correct. So I'll write down here 242,287. And the equity component now is 59,928, thereby making the total portfolio 242,287. If I add, it goes to 3,02,215. 3,02,215. It will continue to remain 302,215 post rebalancing also. Now how do I rebalance? The equity component should be equal to, tell me, portfolio value minus floor value into the multiplier. Portfolio value, students, is 302,215 minus the floor value we already knew was 2,70,000, the whole into 2, correct? The whole into 2. So if you take the calci, 302,215 minus 2,70,000 into 2, my equity component should go to 64,430. I'll write down here 64,430, and at the balancing figure my risk-free asset should be minus 302,215. If I do, it should be 2,37,785, which means what did you do, students? 64,430 minus 59,928, 4,502. Students, this is the amount you will sell from your existing risk-free assets, reduce the risk-free assets by this amount, and that amount which you got now, you will invest in the equity portfolio to increase it to 64,430. This is how you will now rebalance if the Nifty touches 5539.04. Yes. So students, with this, we have completed question number 84. Very simple question it was, based on CPPI. We had to just understand how to rebalance based on the portfolio value, floor value and multiplier. Yes. So thank you very much, students. And with this, we end this module of portfolio rebalancing. Okay, students. So the next question is from the chapter business valuation or corporate valuation. And this is a routine question based on economic value added, EVA. Same to same illustration is there in the study module. Numbers are slightly different. Apart from that, everything is same. Students, I will now pull out my video where I was explaining one batch this entire area of this particular question. I will just pull out that video and give it to you. Watch it. And the solution for this particular question, I am not going to be writing separately. I will place ICAI solution only in my notes, which I will be sharing here. Because if I would have done I would have done the same thing. Okay, so please watch question on EV. Now question 6, I have kept solution in the textbook only, but in the notebooks you can just write question 6 solution in textbook. Question 6 solution in textbook, and there is a reason why I have kept the solution in textbook. First of all, this question is an illustration from ICAI, illustration 5. So it is basically not a part of the practical problems, it's an illustration, but there is something in that illustration that you need to understand. Okay, so for that I will take you, see they have given to you this EVA theory, lot of theory is there, and in that, okay, I hope you know this formula of EVA and all that. Okay, now just take your time and read this paragraph. Read it. In short, they are saying that whatever EBIT you take, no, EBIT 1 minus that EBIT that you are taking, no, make sure it is cash profit and not non-cash profit, which means any non-cash expenses if you have deducted while calculating EBIT, add it back. Everybody clear? You add it back and make it cash profit. That is what they are saying. But then they are putting one exception to the rule, that depreciation don't add back, keep it untouched, meaning let the depreciation be subtracted, don't add it back. Are you all able to understand? We will consider it to be an expenditure. So the example they have given for a non-cash expense is provision for bad debts. You understand, na? That is an example which they have given, which you can then reverse back. Everybody clear? That is one thing about this EBIT. Then what are they saying? After arriving at the correct NOPAT, the next step would be to find the capital charge. This would involve point number A, invested capital. Invested capital means we call it as TCE. Point number A, TCE, and point number B, apply WACC on the TCE. Everyone clear now? You know that. So now read point number A, invested capital paragraph, please. So what they are saying is, see, listen, you people understand that this is balance sheet, assets are there, okay, balance sheet, assets are there is equity, there is debt, and then there are current liabilities, correct? Now do you realize this portion is TCE? Everyone clear, na? This portion is TCE. Can I say TCE can also be calculated as asset minus current liabilities? You're understanding, na? Assets minus current liabilities is also TCE. So in that, now what they are saying is that when you are calculating NOPAT, okay, if while calculating it, if you would have deducted provision for bad and doubtful debts, for example, then can I say here you will have to add it back? Everyone clear? As if we had not passed the entry. Everyone clear now? You have to add back provision for doubtful debts. Students, you tell me, when you pass an entry for provision for bad and doubtful debts, one effect of course goes in the P&L. The second effect, can I say, goes in the balance sheet in the asset side, where the debtors are netted off. I hope you are able to understand. Now, do you understand that if you are reversing the entry in the P&L, you will have to reverse the entry in the asset also? Everybody clear? Like for example, 100 rupees is the provision for bad and doubtful debt. So you are adding it back while calculating NOPAT, no? So at that time you add it back while calculating TCE also. You are understanding? And I hope you sometimes students ask me this doubt. Sir, the debtors are getting rectified. Now why is TCE you are changing? because I hope you understand that TCE externally looks like equity plus debt, but end of the day, can I say it is asset minus current liabilities? So if the assets are changing, can I say, do you realize the TCE will also change? Everyone clear? And the effect will go in the equity component of TCE. Everybody clear now? Debt component will not change. Here, do you realize that if your debtors are changing, I hope you're getting it, if the debtors are changing, see in the balance sheet, look at the screen, in the balance sheet, can I say if debtors are adding, why debtors are adding? Because you must have netted off the provision for bad and doubtful debt. Now can I say you are not taking the provision for bad and doubtful debt. So can I say by that much extent debtors will become, will go up basically. Hello? Correct? To that extent, can I say equity will also go up? Everyone clear? What is the reason that equity will go up? Because I hope you realize if you are nullifying the effect of provision for bad and doubtful debt, accordingly profit and loss will improve. Now, I hope you are understanding. Accordingly, profit will go up, profit goes up, equity component goes up. Everybody clear? So that is what they are telling you in this point. Now students, you read that question number 6 from your textbook, then we'll start understanding. Don't see the solution. So what are they saying? They are saying that compute EVA with the following information. So now they have given to you P&L on the left side and balance sheet on the right side. Okay. I hope you will not say, sir, 280 is not tallying with 1300. They're two different concepts only. Okay. This is a balance sheet and this is a P&L. 1300 tally is here. See. So in the P&L, this is sales minus COGS minus other expenses will give EBIT minus interest, EBT minus tax, NPAT. Everybody clear? This is the income statement. Here, what is PPE? Property, plant and equipment. Very good. This is property, plant and equipment. Basically, in our language, this is fixed assets. Everybody clear? Fixed assets, current assets. Acha, remember, can I say current assets will be including debtors? Remember, current assets will be including debtors. And this 1300 is represented by 800 of equity, 100 of debt. Everybody clear? And this current liability of 400. Now everyone clear? So basically your total capital employed is 1300 minus 400. Correct? That is 900. Can also be represented as 800 plus 100. Everyone clear? Now they are saying assume bad debts provision of 20 lakh is included in the SGA. This includes a provision for bad and doubtful debt. It's a non-cash expense. And the same amount is reduced from debtors in current assets. Everyone clear? We will have to rectify on both sides. Also assume that pre-tax cost of debt is 12%. Basically, this is the interest rate. This is not KD. For KD, can I say you will have to do this into 1 minus T. Everybody clear now? For KD, you will have to do into 1 minus T. And cost of equity, that is KE, is 8.45%. So they are asking you to find EVA. I will leave you with this. Please figure out on your own. I'll wait. I'll of course explain. Take your time. You're done? So first they are talking of NOPAT. NOPAT means our EBIT 1 minus T. Can I say EBIT is 410 into 1 minus 0.3 will give you EBIT 1 minus T. But then they are saying that, oh no, sorry, we have deducted 20 rupees non-cash expense that they are adding back to find NOPAT. Are you able to understand? Now just want to tell you, in the exam your mind will play some tricks with you. I'll tell you what kind of tricks. This non-cash expense that has been added back, should we add it back after 1 minus t or before 1 minus t? Understood the question? That dilemma will come in your head. You know you have to add back, but when to add back, na, that is a dilemma. Students, I don't have an opinion on it. ICAI has added it after 1 minus t. Everybody clear? So please stick to this solution. EBIT 1 minus t. So basically do your normal NOPAT first. EBIT 1 minus t, do normal, and then you add back the non-cash expense without considering its tax effect and all that. Everyone clear? All done? This is NOPAT for you. Now TCE. Now TCE, do you realize is 900? See, 900 from where I got 900? For me 900 is equity and reserves is 800 and non-current borrowing is 100. So basically it is 800 plus 100, that is 900. But can I say 20 rupees will get adjusted in the debtors amount? Everybody clear? And because of 20 rupees getting adjusted in the debtors amount, the equity which is 800 will now become 820. I hope you are able to understand. Equity will become 820 and debt will continue to remain 100. Am I making sense? Hello? 820 and 100, 920. Correct? And that 920, can I say, is TCE, which I now need to multiply by WACC. Everybody clear? I need to multiply by WACC. For WACC, can I say they have given to you interest rate as 12%. 12% into 1 minus 0.3 will give you KD. And cost of equity KE is given to you 8.45. Check their WACC please. According to me, this is wrong, which is why I did not give you solution on my own. I kept ICAI solution only so that, you know, because students, they forgot to do 820 and 920. Check. You are understanding what I am saying? They have forgotten to do it. Then again, when they are doing step 4, when they are calculating invested capital into WACC, at that time they again remembered 920. But while calculating WACC, they forgot it. Everybody clear? So because of that, this solution becomes slightly erroneous. Otherwise, everything else is normal. Then you know now what to do. EBIT 1 minus 307 you have got, minus the 77.65, 229.35 is the EVA. Everyone clear? But apart from that, there is one problem was there in WACC, which is what I just wanted to point out. Okay students, so now let's go to question number 6, which is from the chapter of Forex. A basic question on forward cover, a nice question, okay. They are saying PKR, actually they have by mistake repeated this whole thing twice, starting from here again. PKR has made purchases worth $8 lakh on 1st May, payment to be made on 1st November. So do you people understand that for us, foreign currency payable is $8 lakh in 6 months from 1st May to 1st November. Next they are saying the present exchange rate, that is spot rate, is $1 equal to rupees 75 and the forward rate is $1 is equal to rupees 74, right? Spot rate and 6-month forward rate. Then they are saying if you want to go for the forward cover, you will have to pay a premium, like how you pay for options, no? Like that you have to pay a premium of 1% of the forward amount purchased. Now do you realize the forward amount purchased is $8 lakh multiplied by 74. On this particular amount in rupees, 1% premium we will have to pay. And that is basically 5,92,000 rupees premium you have to pay to the bank. And what does the question mean by upfront? Upfront means you have to pay the premium today on 1st May. The execution of the contract will happen after 6 months, but the premium you have to pay today. Okay. Next, the company can hedge its position with the following expected rate of USD in foreign exchange market. So they are saying that sitting today on 1st May, if we estimate what will be the spot rate after 6 months, spot rate can either be this or this or this or this with these probabilities. Immediately on seeing this, I think you understand we have to do summation px to find the expected spot rate. So that's what I did. I did summation px and I found the expected spot rate to be 74.7. So they are saying you advise the company for a suitable cover for risk assuming cost of capital is 10%. So basically you have got two options. One is you don't hedge, other is you hedge. Let us first talk about hedging. Can I say if you go for hedging, there are three costs or three outflows I might say you have to incur. The biggest outflow of course you have to incur is you have to purchase $8 lakh at a fixed rate of 74. This is one. Second, you have to pay a premium for this, that is second. Third, if you want to add all the costs, the third item that will have to be taken into consideration is the cost of capital, the opportunity cost. What do I mean by it? Do you realize that 8 lakh into 74, this outflow will happen on 1st of November, that is after 6 months. The premium however will happen today, that is 1st of May. I can't add these two to find the total cost. So the premium that I am paying today, I will take a future value of it. I will compound it at the rate 10%, correct? I'll compound at the rate 10% for 6 months, bring it to future value and then I'll add it. So students, in my notes I've done like that if we hedge using forward cover, my total outflow will be purchase of dollar under forward cover. This number we have already calculated. Apart from that premium we have to pay today, 5,92,000 already calculated. And on that premium I am also adding the interest for time value of money calculation, 592 into 10% for 6 months. So my total outflow comes to 5,98,21,600. The second option I have is don't hedge. Students, if you don't hedge, then all this is out of the window. The $8 lakh that you want to buy, on an average, can I say this is the rate that we will estimate today at 74.7. So if we do not hedge, then the total outflow is purchase of dollar at spot, 8 lakh into 74.7, that comes to 5,97,60. Do you realize in forward cover it is 5.98 crore, here it is 5.97 crore, hence the conclusion is do not hedge since it is cheaper, correct? So with that students, we finished the discussion to question number 6. Let us now go to question number 7. Students, question number 7 is a very routine question on Nostro account. So what I will do is, I will now pull out my video where I was teaching a similar question from ICI model only on Nostro account. Go through it and then this question also you can consider done. Nothing new in this particular question. Please watch the video on Nostro account. Okay, please come to question number 10. Don't write up with me, there is a reason. Okay, are we ready? So what are they saying? You have the following Swiss franc position. Okay, so here instead of dollars we are dealing with Swiss francs. Everyone clear? CHF. What are they saying? Balance in the Nostro account, credit balance. Can you tell me this is a cash position balance or exchange position balance? Cash position. Account, na, my basic bank passbook is the cash position only. So 1 lakh is the opening balance. So see what I am doing. Don't write down please. I am writing here opening balance 1 lakh. Everyone clear with this? Opening balance in credit is 1 lakh. Then Opening position over bought. What does this mean? That means, do you realize when the last period was closed, my buys were greater than the sells by CHF 50,000. Everybody clear? So that will be taken as the opening balance here. So here I will take opening balance and I will start from here. Hey, everyone following now? Clear till here? Okay. Now take your time and let's read. Purchased a bill. Now students, purchased a bill can be interpreted as received a check. I hope bills of exchange, na? Hello. So it's like a check. You received a check. You just received a check. You have got a check of 80,000 Swiss francs. Take your time. Take your time and first tell me in ABCD language. You have just received a check. Check you got of Swiss francs. Tell me where will you show it? A, B, C or D? Very good. Do you realize you will show it in C? Everyone clear? No? You will show it in C because you bought it. In a sense, you don't think that, oh, but where did I buy and all. Don't use this nonsense language. Coming in means buy. Everyone clear? Okay. So that 80,000 that Swiss francs you got now, I will show here. I will write here purchased a bill and that will be 80,000 in buy. Sir, why is my cash position not getting credited? Because sir, Swiss francs will go in my bank account now. My bank account will get credited. No, it will get credited only when the bill is presented for payment. Everybody, are you all able to understand? Till that time you can't do it. Till the time it is cleared. Oh, hello. You're understanding, everyone following? Okay, next. TT stands for telegraphic transfer. Ignore it. Just read sold forward. Hey, what do you mean sold forward must be? That means you must have entered into a transaction to sell CHF some months forward. Everybody clear? To sell CHF some months forward. Take your time and tell me A, B, C, D. You entered into a forward sale agreement. Forward sale agreement. Where will you put? Of course in D. Everyone clear? Of course in D. But sir, if I am selling CHF will go now, my debit also will happen. No, debit will happen on the due date. I hope you are understanding. Today only you have taken a position to sell forward. So that also will come only in the exchange position 60,000. So here I will write sold forward 60,000 will come in sell. Everyone clear? 60,000 will come in sell. Next. Okay, now this is going to be interesting. You have to use your brains. I have already taught you, but still try. Forward purchase contract cancelled. Take your time. Forward purchase contract cancelled means you had entered into some forward purchase contract in the past. It is not mentioned in this question when you purchased, etc. Are you all there? In the past there was a date when you had entered into a forward purchase contract. Today you are saying I don't want to execute it, I want to cancel it. Okay, so you are cancelling. Tell me where will you show it? A, B, C, D. It is D. Everybody clear? You will show it in D. Why you will show it in D? Because when you must have entered into a purchase contract, forward purchase contract, you must have shown it in C. I hope you are understanding. You must have shown it in C. You are now cancelling it off. Hey, everyone following? Huh? You are now cancelling it off. So I will show it in cell. So I will write here forward purchase cancelled. How much is the amount? 30,000. I will show it in cell. Everyone clear? 30,000. I will show it in cell. Okay, take your time. Read the next. Remitted by telegraphic transfer. In today's language, you consider this to be electronic transfer. Okay, remitted by electronic transfer. Take your time. You are saying that I just did one online transaction, 75,000 Swiss francs. I just remitted to somebody. Take your time, use your brains, tell me where will I show? I remitted by electronic transfer 75,000. Where will you show? Very good. People are saying A, wrong answer. It is A and D both. I hope you understood. A is not wrong, it is half right. You understood, no? A is half right. Yes, it got debited from your bank account on the spot, it will get debited. But you forgot to show it in D also. Everyone clear, no? Sell also will happen, no? Hey, everyone following? Okay. So here I will write remitted by TT. How much amount? 75,000 will go in sell, and here also I will write remitted by TT, and that 75,000 I'll put in debit. Everyone clear? It will get debited from my bank account. Okay. Next, there is a demand draft which got cancelled. Now which we are cancelling. Now students, first things I want you to think, which demand draft will you cancel? A demand draft that you have received or a demand draft that you have issued? Think na, tell me, which demand draft will you cancel? The demand draft you have received or demand draft you are issuing? Think can reply. Huh? Of course issued. Why will you cancel a demand draft which you are receiving? Nobody cancels a receipt. You are understanding, no? Unless you are from science and arts background. Hello, I hope you are getting it. Commerce, who will cancel a demand draft which has got received? No, a demand draft which you have issued, you will cancel. No, okay, stop payment. Nobody does stop receipt. Everyone clear? Anyways, so this demand draft you must have issued someday in the past. When you must have issued, can I say you must have shown it in D? Come on everyone, when the demand draft was issued, a demand draft means check, baba. You gave a check to somebody. That check when you gave, you must have shown it in D. Now before the person was able to clear, we are cancelling it now. So tell me, where will it come? Can I say on cancellation it will come in C? Everybody clear? On cancellation it will come in C. So you understood why I am putting it in C? Okay. So C means what? Buy position. So I'll write here demand draft cancelled. And this will come, how much? What is the amount? 30,000. Demand draft cancelled, 30,000. All clear? So with that students, we complete the discussion to this particular question. Now there is just one last thing that you have to understand before you start writing. What steps would you take if you are required to maintain a credit balance of 30,000 in the Nostro account and keep an overbought position of Swiss francs 10,000? Okay, I'll explain. First of all, tell me what is the total. Boys, tell me total buy. Girls, tell me total sell. 1 lakh. क्या है? 1,65,000 is here. 1,60,000 is here. Students, do you realize as of now there is a net balance of 5,000 in the sell? Come on everyone, clear? My sell is more than the buy by a total of 5,000. Everyone following till here? Now coming to cash position. In cash position, total of debit is 75,000. Total of credit is 1 lakh, which means, do you realize that there is a net credit position of 25,000 in the bank account? Till your story clear? Now what are they saying? They are saying that no, we don't want it like this. In the exchange position, we want it to be closing at an overbought of 10,000. Everybody clear? We want it to be closed at overbought of 10,000. Can someone tell me what step you need to do to convert this 5,000 to overbought of 10,000? Story understood now what I am trying to say? You will have to buy. Very good, simple. Now right now you are having your net position is sell 5,000. You are saying I want net position of buy 10,000. So I should buy 10,000, I should buy 15,000. 15,000. Everybody clear? Because to go from sell 5 to buy 10, I'll have to buy 15. Everyone clear? Hello? Okay. Now one question is there. What you want to buy, spot or forward? Take your time. Anything is okay, na, like that actually. Because whether you buy spot or whether you buy forward, can I say it will come in the buy position? I hope you are able to understand. The only thing that you have to understand is if you go for spot position, then it will also affect your cash position. Are you all able to understand? It will go in the cash position also. If you go for a forward, then can I say only forward position, only exchange position will get affected. So temporarily, let's say we go for a forward. Everyone clear? Let's say we go for a forward, buy forward 15,000. If you buy forward 15,000, see, I'll write here, buy forward 15,000, then do you realize you will end up at 10,000 overbought in the closing? Everyone clear? Now, this is not getting affected. Everyone ready? Now, as far as cash position is concerned, now in cash position, you are wanting to keep a credit balance of how much? 30,000. What is your credit balance as of now? 25,000, correct? Can you tell me on the chat box what you need to do to close this position at 30? Come on everyone. Right now it is 25, na? To close this at 30, what you need to do? Do you need to buy CHF or you need to sell CHF? Take your buy. You need to buy CHF worth how much? 5,000? Hello? You need to buy CHF worth, hello? You're understanding? So, tell me, 5,000 rupees, I'm sorry, 5,000 CHF, can I say you will have to buy? 5,000 CHF you will buy, na? You will buy forward or you want to buy spot? Take your time and answer. You want to increase your cash position from 25 to 30. You will buy forward or you will buy spot? Spot. You will buy spot, no? Because if somebody is telling we should buy forward. If you buy forward, then how will your cash position get affected? Everybody clear now? You have to, for cash position to get affected, you need to buy spot. Hello? Didn't understand? Understood? But when, so I will write here buy spot. How much? 5,000. Do you realize that will become 30 then here? But then what is the problem? Then this, if you buy spot, do you realize you will have to show in the exchange position also? You are understanding? So what, you should buy forward? If you buy forward, then only exchange position will get affected. Tell me what to do then. You have to do something that affects the cash position but not the exchange position. Do you realize it is not possible? How is it possible? How can you say I will go and buy 5,000 CHF but exchange position I will not show? It is not possible now. You will have to affect the exchange position also. So did you understand? You are stuck now because anything you do to close the cash position, anything you do to close the cash position, do you realize exchange position will get affected? Everyone clear? So students, what you did is wrong in terms of sequencing. Sir, what do you mean by in terms of sequencing? ICAI says always close cash position first. Did you understand logic? Always close cash position first. So I will now remove this. I will go to the cash position. Okay. This was the situation till now. Now tell me, cash position 25, I want to bring it up to 30. So if in cash position I want to bring it up to 30, in the bank account I want it to go to 30, will I buy forward or will I buy spot? Spot. I will buy spot. So I will write here, buy spot 5,000. And do you realize that will therefore give me closing credit balance of 30. Everybody, are you all able to understand closing credit balance of 30? The moment I buy spot, it is like buying through electronic transfer. The moment I buy, it is of course crediting in my bank account, but I will also have to show it in the exchange position. Everybody clear? In the exchange position, where will I show? Buy or sell? Tell me now. Buy, na? Of course, everybody clear? We'll show it in buy. So I'll write here buy spot. This is to close the cash position. Okay, I'll just take it one line below here. Okay, to close the cash position 5,000. Till your story clear? Now because of this, what is happening? Because of this, do you realize on both sides now, it is 1,65,000 and it is 1,65,000, which means, do you realize that the net balance is zero here? Everyone clear na? In the overbought position, oversold position, there is nothing overbought, oversold. It is getting cancelled off. Now use your brain and tell me, but you want how much to be the closing in the exchange position? In the exchange position, you want the closing to be overbought 10,000. Everyone clear? Overbought 10,000. So what to do for that? For overbought 10,000. Come on, tell me right now, what is the situation? Right now, do you realize it is zero? So from zero to go to overbought 10,000, you will have to buy 10,000. You will buy spot or you will buy forward? Forward. Why? What is the problem in buying spot? Then the cash position will also get affected. Everybody clear? I don't want to affect the cash position. So I'll write here buy forward. Okay, 10,000. And this, do you realize, will then give you your closing overbought position. Everyone clear? Closing overbought position is how much? 10,000. Story clear? Closing overbought position 10,000. Done? So I'll write here note, always first close cash position and then show its impact on exchange position. Then close exchange position with a forward transaction so that it does not affect cash position. Otherwise, ringa ringa roses. You are understanding, no? Everyone clear? Okay students, now we move on to question number 8. That is from the chapter of Advanced Capital Budgeting. One of the most simple questions they have picked up. That is on the basis of utility analysis. Utility analysis tells you that every cash flow you get gives you some level of happiness or utility, and on the basis of that concept, this question is there. Since years, this only one question is there on utility analysis, so I will just pull out my video explaining this very question. Please watch it. It's very simple, nothing great, routine calculation. Okay, please watch. Come to question 34. Jumble Consultancy Group. Jumble. Read Jumble Consultancy Group question. It is pathetic. And if I remember correctly, this came in my exam also. So it is not so pathetic, but conceptually it is really bad. Everyone ready? See what they are saying. Jumble Consultancy Group, Boston, has determined relative utilities of cash flows of 2 forthcoming projects. Okay. All the best. If you go for project A, you can either get negative 15,000 or negative 10 or positive 15 or positive 10 or positive 5 with these probabilities. Correct? What ideally you should have done? You should have calculated summation px of this, summation px of this. Whichever one gives you higher summation px, we will go for it. It is that simple, no? Hello. But they had other plans. Bro got no chill. What they are saying, they are saying that no, 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 to hell with all this. If you are going to get negative 15,000 cash flow, no, then you will be dissatisfied in life 100 points. Utility, you remember, is level of satisfaction. If you get negative 10,000 cash flow, no, you will be dissatisfied less. If you get positive 15,000 cash flow, no, 40 units of happiness, khushi. If you get 10,000 cash flow, no, you will get how much? 30 units of happiness. I hope everyone is under. Oh God. Now see, when you come to final, you realize how irrelevant diminishing marginal utility concept was. Because how the hell can you draw a graph for utility? How can you quantify happiness? Looks like my stipend. Arey, you are not paying stipend to your firm, na? Hello, ready everyone? I am working, please take stipend. Allow me to work. Huh? So, do you people realize what you have to do is, instead of 15,000, you have to put negative 100 units of happiness. Instead of 10,000, you have to put negative 60 units of happiness. From where am I getting this happiness? From the first table. I hope everyone is clear. 15,000 cash flow, I'll get 40 units of happiness. 10,000 cash flow, I'll get 30 units of happiness. 5,000 cash flow, I'll get 20 units of happiness. Negative 10,000 cash flow, I'll get negative 60 units of happiness. Negative 4,000 cash flow, I'll get only, and I'll be dissatisfied only for 3 units. 15,000 cash flow, I'll get 40 units of happiness. 5,000 cash flow, I'll get 20 units of happiness. And 10,000 cash flow, I'll get 30 units of happiness. What? 10,000, bro, no? Correct? Okay. Now, once you have this, then students, I don't know all this. There is a 10% chance that you will be dissatisfied 100 units. There is a 20% chance you will be dissatisfied 60 units. 40% probability 40 units. Can I say you have to do summation px on the happiness? Come on everyone. On the get the average expected utility. Can I say whichever project gives you higher summation px on the utility will be selected is the question of jumble consultancy. This is how they do consultancy. Everyone clear? Only all India rankers they take, hello. If you want job here. Okay. So can I please go ahead? So students, I am not interested in solving this. You can see it from here. Okay. 15,000 negative utility multiplied by probability, average utility, total average summation px comes to 2, summation px, oh God, look at project B. There are 17 units of happiness that you are getting. Therefore, we should go for project B since its utility is higher. Okay students, so now let's do question number 9. From the chapter of interest rate risk management, again a routine normal question which we have been doing. And all of you must have seen this overnight index swap question. Students, very old question, frequently asked, it keeps coming. Please watch my video explaining this particular question to a batch and we'll move on. Okay, there is nothing great in this particular question also. Question number 8. This is a very typical one-time question, keeps repeating in the exam. Please understand exactly how it is to be solved. Question 8. I'll just see if it's there. Okay, so I'll start. Students, let me explain this. This is a very simple question, but there is something in the question that you need to be very alert about, okay? Derivative bank entered into a plain vanilla swap through an overnight index swap on a principal of 10 crores, okay? And agreed to receive MIBOR, Mumbai, interbank offer overnight floating rate for a fixed payment on the principal. Okay, please understand the story. This bank, derivative limited, not bank. It's a company. Otherwise bank will get confused. It's a company. It entered into a swap. What swap? First of all, to do what and receive what? Can I say to receive MIBOR and pay fixed. Okay, it's paying fixed, receiving floating. Now the question is, what do you mean by overnight swap? Students, overnight index swap means, now in the questions that we did, you remember Microsoft and Intel? It was not overnight swap, it was 6-month swap, meaning after every 6 months, there was a reset period. I hope everybody is there. In overnight, every day is a new reset period. See, please understand. You remember there was, in 1 year, there are 2 periods of 6 months each. For the first 6 months, the interest rate which is there at the start of the 6 months is relevant. And for the next 6 months, the interest rate which is at the end of the first 6 months becomes the interest rate for the next 6 months. Start period, na start. Now please understand, between month 0 and month 6, month 0, whatever interest rate was there, can I say applicable for that 6 months? You will pay it here at the end of 6 months. But do you realize from year to year, interest rates would have fluctuated anyhow? That will not affect you for the first 6 months at least, because for the first 6 months, the interest was frozen on the first day. But do you realize interest rates don't change once in 6 months. Interest rates can change every day. Which means, can I say floating rate loan? It all depends on what is your frequency of resetting. We saw in one question the frequency was quarterly. We saw in one question the frequency was semi-annually. We have seen in one question the frequency was annually. Here the frequency is daily, which is meaning of overnight. I hope everybody is clear. Overnight does not mean the swap period is only 1 day. Overnight means the swap period could be 10 days, but there are 10 reset periods. I hope everyone is clear. Getting clear. Every day new interest. Every day we will check net gain, net loss, net gain, net loss, like that. I hope everyone is there. Hello. Huh? Institute has solved it in a particular fashion. Please understand, okay? So, principal is 10 crore. The swap was entered into on Monday, that is 2nd August, and was to commence on 3rd August. Okay, so basically it commences on 3rd August and will run for a period of 7 days. Okay, it's a 7-day swap. Everyone clear? Respective LIBOR or MIBOR for Tuesday, that is 3rd August to Monday. Okay, they have given to you all this. So this is Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday, Monday. Because Sunday is a holiday, this is applicable for 2 days. Now what happened in this is, ideally settlement should happen how many times? 7 days means 7 times, no? Here the problem is that the settlement, where is it? The settlement is only once. I hope everyone is clear. They are saying the derivative bank received 317 one shot. Now this, children, do you realize is the total settlement of 7 days. It is not daily. Come on. It is not daily. It is total of 7 days. Everyone clear till here? Okay. They are saying if these are the floating rates and you have net received 317, then what is the fixed rate that you have entered into? So that is the question. Because can I say floating rates are given? Fixed rate is not. It's an interesting question. Fixed rate is not given, but settlement amount is given. You have to reverse calculate and find the fixed rate. But before that, there is something that I want you to understand. Okay. I want you to first tell me, are you paying floating or are you paying fixed? Take your time. In the swap, In the swap, can I say we are paying fixed? We are receiving floating. Can I say the receiving part clarity is given? Come on, everybody. Receiving part clarity is given. Payment part I don't know, but I know one thing, net I received 317. So the balance will be another payment. We'll talk about it, don't worry. Everyone ready till here? Now, let us only talk about, look at me, receive under swap leg. Everybody clear? Because pay under swap I don't know, only fixed rate only I don't know what to do. So pay under swap I don't know, receive under swap, let's calculate. Everyone there? Okay. Now ICAI has done it in a particular fashion. You have the question in front of you, no? So I'm taking you to the solution. Question you all have, no? Hello, 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 hello. Okay. So, okay. Let's go slow. Tuesday, first day, everyone. Principal, can I say 10 lakh? 10 crore, sorry. MIBOR 7.75% is the first MIBOR given to you, correct? Hey, this is applicable for how many days? Very good. Get me on calculator if you can get me this number. Got it? What did you do? 10 crore into 7.75% into 1 by 365. All got it? Now students, look at me. Since this is resetting every day, ICAI has assumed daily compounding, and because of that for Wednesday, you have to take a principal of 10 crore 21,333. Hey, everyone, are you all able to understand? Remember this in exam. Where it's a simple question, but remember this point. Okay, students, like that, can I say second day interest? Tell me, are you getting this? Now like that, I want you to go on and get it everything till here, everyone. On Calci, everybody practice it, please. Practice the whole thing. Now you just get me these numbers. Did you get these numbers? Please check first. Especially Saturday, Sunday, check how they have done. Within Saturday, Sunday, compounding is not happening. They have done simple interest for 2 days constant. You understand, na? What did they do? They took this number into this rate into 2 by 365 straight away. That is what they have done. Just check once more. I don't know, they will keep changing their answers, but all done. Did you get the total interest of 153,740? All number clear? Even if you check 3-4, it's okay. Main you check Saturday, Sunday, please. I taught you first, second. Now Saturday, Sunday most important. Done? Okay. Sunday is a holiday and all that, okay? And they are specifying also as if we did not understand. Interest for 2 days. Okay. All clear? Now, students, now look at me. Ideally in an overnight swap, settlement should have happened every day. But here settlement is happening in 7 days, one shot. Everybody clear? So one shot settlement happened how much? 153,740. We had to pay or we had to receive? We had to receive. Come on everybody. Floating is received, na? Hello. This is the floating interest. Everybody clear? So 153,740 we had to receive. But sir, we received only 317. Come on everybody. We received only 317. Hey, that means the embedded payment that we must have done is 153,423. Come on everybody. Net na net. This is what I must have paid. Paid in a sense, in the calculation, my payment must have come to 153,423 and the receipt must have come to 153,740. So that is why I net received 317. Now the question arises that if I had to pay 153,423, what is the effective interest rate in the fixed leg that I must have committed to? Understood the question, what I'm trying to explain? Hello. Now what ICAI has done, it is saying, look, they have got 8%, no, this answer. I'll tell you how they must have got. 10 crore is there, 10 crore. I want to know what is the fixed interest rate. Hello, everybody clear? What am I writing? Okay. I want to know what is the fixed interest rate. Everybody clear? Can I say over a period of 7 days? hello, which comes to 153,423. This number. Everyone, are you able to understand? Can I tell you therefore that in the fixed ICEA is not doing daily compounding? ICEA is taking one shot 7 days. Think about what I'm trying to explain. They are not doing every day compounding. They're saying, okay, one shot this percent on this period, on this amount for 7 days, like how they did for Saturday, Sunday, no? You felt something was going wrong Saturday, Sunday because this compounding did not happen for Sunday. Like that compounding did not happen for all the days in the fixed. Check now, are you getting this number 8%? Please check. All getting clarity? Students, let's not debate it. Do it as it is. Get your 8 marks. Everyone there, it's an 8 mark question. All done? Hello. So what I can do is, for fixed interest rate, I'll say 10 crore into X by 100 into 7 by 365 should be 153,423. Correct? You can do that calculation, and I think this much is the answer. That's it. Okay friends, let's now do question number 10 from the chapter Security Valuation. Here they have asked questions on the concept of money market instrument. If you have seen your security valuation study module, last 3-4 questions of the practical problems are based on this only. They are saying the bank PK enters into a repo for 9 days with bank JJ. To cut it short, bank PK has borrowed loan from bank JJ. Game over. But for borrowing, bank PK sells securities that it owns. It must have invested in some government securities, government bonds 2022 having a coupon of 6% that it sells to JJ and in turn takes a loan. And then students, when the loan period is over, then the loan is repaid by PK to JJ, who then gives back the securities. PK repurchases the securities from JJ. This is in short what it is called as repo, repurchase agreement. Anyways, so for an amount of 20 crores. The other relevant details are as follows. Now students, what does this mean? First leg payment. First leg payment basically is your loan principal amount. Okay. This is your loan principal amount. So 20 crore was the face value of these bonds, but the loan given was 20 crore 67,500. Second leg payment, students, refers to the maturity value of the loan. So when the loan is to be repaid, PK will be paying 20 crore 3,17,590. Initial margin is 1.25%. This I'll tell you in some time what it is. And days of accrued interest also I'll tell you in some time what it is. Now, assume 360 days in a year. They are asking you to calculate repo rate. Now, repo rate means simply they are asking you at what rate JJ is offering loan to PK. Now, do you realize for that we have the loan amount, we have the maturity proceeds or the maturity value of the loan, and we know that the loan is for 9 days. We have to find R. PV you have, FV you have, correct? N you have, number of days you have. You have to simply find R. So very simple question. I have written it here. Loan amount this, period is 9 by 60 years, maturity value is this. So can I say future value is equal to present value into 1 plus R? And when you solve this, you get the repo rate as 5%. Moving on students, the next thing that they are asking you is dirty price. Now let me explain this. Students, the face value of the bonds, okay, the face value of the bonds was 20 crore. Why then the loan given was more than 20 crore? Because when PK is selling the bonds to JJ, the value of the bonds that JJ is receiving won't be the face value, right? It will be the market value of the bonds. Hence, the loan which is given by JJ to PK will be on the basis of the market value of the bond, and that market value, students, is called as dirty price. So our job is to find what is the current market price of the bond, and we will assume that face value per bond is rupees 100. We will assume per bond face value is 100. Why it is called dirty price, I will tell you in a while. Right now, just focus on calculating the market price. It is also called as dirty price. It's a different thing. Okay. Now market price. So students, very simple. What we have to do is, we have to understand that let's say face value per bond is 100, correct? So 20 crore rupees of face value means, do you realize that the number of bonds that PK is selling to JJ is 20 lakh, correct? 20 lakh bonds. 20 lakh bonds into 100 is 20 crore. So 20 lakh bonds PK is selling to JJ, correct? Now students, let the market value of those bonds per bond be X. So can I say the total market value will be 20 lakh X worth of bonds that PK is given to JJ. So ideally this should be the loan that JJ gives to PK, but then kicks in the initial margin where JJ says that, okay, you give me this bond value, but this minus 1.25% I will do, I will deduct margin, and balance I will give you the loan. So this number that you see here, that is the loan given by JJ to PK, is after deducting 1.25% from the market value of the bonds. So you have to simply equate these two equations, that this is the loan amount that JJ will give. We know the loan amount is 20 crore 67,500. We can equate both and find the market price per bond. So I have written here, let face value per bond be 100. Can I say number of bonds therefore will be 20 lakh. Market value per bond, let it be X. So as we discussed, 20 lakh X will be total market value. Initial margin that the lending bank is deducting is 1.25%. So 20 lakh X minus 1.25% is coming to 19 lakh 75,000 X. We know the loan given is 20 crore 67,500. When we equate both, we get the market value as 101.3. Now comes the question, why is it called as dirty price? It is called as dirty price because, see, on the day when PK is entering into this repo agreement with JJ, these government bonds which it is selling are having 240 days of accrued interest already in it. So you must be knowing the concept of cum interest price and ex interest price. So 240 days out of 360 days, interest is accruing, which means the market value which we got just now, 101.3, can I say is the cum interest price, including the interest of 240 days. So students, hence it is called as a dirty price. It is not the price of the bond alone. It is the price of the bond plus accrued interest that gives you the cum interest market price. This cum interest market price is called as dirty price. And without the accrued interest, if I subtract the accrued interest from this cum interest price, the basic value of the bond that I get is called as clean price of the bond. Simple. So in point number C, they are asking you clean price. What to do? You already have dirty price. No, subtract the accrued interest from it. 240 days interest to subtract. What will be left is the clean price. So that's what I have done here. Face value 100, interest rate 6%, days 240, cum interest price 101.3. Do you realize X interest price, that is clean price, will be clean price plus accrued interest is dirty price. Dirty price we have 101.3. Accrued interest, can I see, will be on face value 100. 6% is the government bond interest for 240 days. This is the accrued interest. Can I say if you calculate for X, you will find the clean price as rupees 97.3. Everyone clear? So with that we finish the discussion to question number 10. Now that 10th is done, we will now go on to question number 11. Question 11, students, is an amalgamation of security valuation, portfolio management, everything. See, in portfolio management you have been taught the concept of short selling, or even in derivatives you might have been taught the concept of short selling. What is short selling? I think that a share is going to drop in value, so I want to sell the share today and buy it later. So if I sell it now at this price and buy it later at a lower price, I get profit. That is called as short selling. But to do this, the procedure is that I will have to borrow a share from someone and then sell it. Okay? And then when I buy it back, I will give it back to the person. I'll give the share back to the person from whom I had borrowed. Now in this there are 2 points. First, when I borrow the share from someone to sell it, I will have to pay some charges in the form of interest, because that person is literally lending their asset to me, correct? So I will have to pay interest for that period for which I have short sold to the person from whom I have borrowed. Secondly, if during this short sale period, let's say I have sold the share today and I am planning to buy it back after 3 months and then give it back to the lender. If during those 3 months the company whose share I have short sold announces dividends, then I will have to pay from my pocket to the share lender, because the share lender will say what? That it was my share, I lent it to you, but the dividend that I was supposed to get, that I should get only. So therefore, do you realize that I will have to pay from my pocket to the share lender the dividend, if any? Everyone clear? That is the rule. So now let's read this question 11 through that lens. Mr. A is holding 10,000 shares of face value 100 each, which means that person, Mr. A, what is the value of the shares that he is holding? 10,000 into 100, that is rupees 10 lakh. Of this company XYZ, he is wanting to hold these shares for long term and has no intention to sell. So students, why is this line given? This line is given so that you can understand that Mr. A would be a person who would be willing to lend the share for some time and then take it back, because he is not planning to sell it off. On 1st January 2020, ABC Limited has made short sales of this company, and therefore for that it approaches A to lend the shares under the stock lending scheme with following terms. So slight error in the way the question has been framed. Please understand that first XYZ will have to approach A to lend the shares, only then he can do, or it can do short sales. So let's say A has agreed to lend the shares. Now what are the terms? The first term is shares are to be borrowed for 3 months period. Okay, so here the stock lending will be for 3 months, which means ABC Limited has 3 months. It will sell the share today, and in 3 months it will have to buy back the share and give it back to Mr. A, irrespective of what the price of the share will be. Then can I say ABC will be praying that the value of the share should go down, because a person who short sells has a bearish view, because they want to sell at a higher price and buy lower, right? Okay. Point number 2. Lending charges of 1% to be paid every month on the closing price of the stock quoted in stock exchange. So students, this 1% is basically the interest charges that ABC will have to pay to Mr. A for borrowing these shares. Okay. Point number 3. And by the way, in point 2 they are saying the 1% will be calculated on what? On the closing price of the share quoted in the stock exchange at the end of every month. So every month whatever closing price of the share will be there, on that 1% will be charged by Mr. A to ABC Limited on 10,000 shares. Point number 3, bank guarantee will be provided as a collateral for the value as on 1/1/2020. Cost of bank guarantee is 8%. What does this mean? I'll tell you. So Mr. A, when he is lending the shares to ABC so that ABC can do short selling, can I say Mr. A does not technically, practically know ABC Limited, and therefore Mr. A will always feel that he is at risk. What if MS ABC does not fulfill the commitment of giving back the shares? They will borrow right now, but what if they don't give it back, etc., etc. All that tension Mr. A will have. So Mr. A will tell ABC that I will give you the shares, but only if I have some bank guarantee. So ABC will have to approach separately a bank and purchase a guarantee, right? And that bank will then tell A, don't worry, I am there. But for that the bank will charge ABC something. How much will bank charge ABC? 8% per annum. Now do you realize you'll have to multiply this by 3/12, because we are doing only for 3 months. And this 8% into 3/12, this percentage has to be applied on what? It has to be applied on the value on 1/1/2020, which means on the date when the borrowing happened, on that date whatever is the value of the 10,000 shares, on that value 8% into 3/12, ABC will have to pay extra as a bank guarantee. On 29/2/2020, the company declared a dividend of 25%. As I told you already, who has to pay this then? ABC will have to pay this to Mr. A, because Mr. A deserves this dividend. Okay. Now, point number C. Closing price of ABC's share quoted in the stock exchange on various dates are as follows. So all these different dates are given to you. You are required to find out point number 1. What is the earning of Mr. A through the stock lending scheme in both scenarios? So students, what is Mr. A earning through the stock lending? Can I say lending charges? Whatever lending charges are there that he will earn. What are the lending charges? 1% of every month end closing share price. So do you realize now they have given to you all this. So this is today and this is end of Jan, end of Feb, end of March. So now scenario 1 bullish. Please understand little typing error has happened in ICAI. Actually this question was there in May 22 RTP also, May 2022. Same mistake they had done. Here they were supposed to write, okay, not bullish, but it was bearish, okay. You can see bullish means the share is going up, bearish means share is going down. There are two scenarios that they have given. Also in the May 22 RTP, they forgot to print this line, point number B. But in the solution, the effect of that 25% was there, okay. But now they have rectified it. In fact, they had given one corrigendum also for May 22 RTP, and now in this particular RTP, they have rectified it, okay. So, but this point is yet to be rectified. So, let us talk about scenario 1. So, this particular share, can I say today is 1000. What if it becomes 1020, 1040, 1050 is what they are asking you. Can I say from Mr. A's point of view, he will be getting the interest charges, that is the lending charges, lending fees on the month end price, right? So, can I say 1020 into 1% plus 1040 into 1% plus 1050 into 1%. Do you realize this is what Mr. A will get, and this of course whatever you got multiplied by 10,000 shares, you will get the total lending charges that Mr. A earned. Similar calculation can I say we will do for scenario B also. I'll show you my solution. You can see earnings for A under stock lending scheme scenario 1, 1020 into 1% plus 1040 into 1% plus 1050 into 1% into 10,000 shares, 3,11,000, and similarly here 2,88,000. Okay. Moving on, they are asking point number 2. What are the total earnings of A in this period under both scenarios? Students, can I say total earnings means one is lending charges. Second, can I say dividend also Mr. A will receive now from ABC. How much dividend will Mr. A receive? Do you understand 10,000 shares into 100 is the face value of the shares? Can I say that multiplied by 25%? That much dividend Mr. A will receive, correct? Under both scenarios, same dividend he will receive. So whatever answer we got here, do you realize apart from these earnings, dividend also Mr. A will earn. So total earnings for A will be lending charges plus the dividends. So lending charges we have already taken plus the dividends we are taking, and that makes it 5,61,000 and 5,38,000 under both scenarios. Last point they are asking you, what is the profit or loss to ABC by shorting the shares through stock lending scheme in both scenarios. So let us now understand from ABC's point of view what all is the profit loss. So first of all I will just explain to you from the point of view of bullish. Can I say from ABC's point of view, there is a sale at this value and they will close the transaction by buying at this value. So 1000 is the sale, 1050 is the buy. Can I say here there is straight away a loss to ABC. Apart from this loss, do you realize that there are two more charges that ABC has to pay? One is the lending charges, one is the bank guarantee charges. Now lending charges, how much ABC has to pay, we have already discussed, right? What Mr. A earned, that only is what ABC is paying. Now as far as bank guarantee is concerned, do you people understand that bank is saying what? That whatever is the value on 1/1/2020, okay, the value on 1/1/2020, do you realize will be 1000 shares multiplied by 1000. Everyone clear? This is the market value, okay? Now students, do you realize 10,000 shares into 1,000, this is the market value of the shares on this 8% for a period of 3 months is the charges that ABC will have to pay for bank guarantee. So what are the two charges that ABC has to pay? One is lending charges, which we have already calculated. Second is bank charges, which will be nothing but 10,000 shares into 1,000 into 8% into 3 by 12. Correct? So these two charges, can I say ABC has to pay? Apart from that, there is a loss on the short sale. So do you realize there are three outflows for ABC? Loss in the short sale. Second is lending charges. Third is bank charges. Everyone clear? So I'll just show you the solution. Okay. Can you see here? 1,000 is the sale, 1,050 is the buy into 10,000 shares. 5 lakh is the loss under the bullish scenario for ABC. Apart from that, lending charges we already discussed some time back. Bank guarantee, as I told you, 10,000 shares into 1,000 into 8% into 3 by 12, 2 lakh. The total loss under the bullish scenario, can I say, is 10 lakh 11,000. Now as far as bearish is concerned, do you realize the lending charges we have already discussed? Bank guarantee charges will remain same only. Now what is this 6 lakh? I'll tell you. Can I say there is a sale at 1,000 here in the bearish and there is a buy at 940 here. So in bearish, can I say they will gain. So sale at 1,000, buy at 940, there is a gain, and that gain, students, on 10,000 shares comes to rupees 6 lakh. Apart from this 6 lakh, of course, lending charges and bank guarantees there. So the net profit here comes to 1,12,000. Okay. Students, this solution of mine, presentation might be slightly different than ICAI, but answers are exactly same. Now, I'll tell you personally, there are two issues that I have with this solution. Issue number one is, as far as total earnings is concerned, yes, this is correct, but there should have been one more. You know what should have been come here? The appreciation or the depreciation of the share price. Students, we do know P1 minus P0 plus D1 we have taken into consideration, but that P1 minus P0 has not been taken into consideration. For example, in the bullish transaction, can I say 1,000 became 1,050? This also gain is of Mr. A only, no, because the share still belongs to Mr. A only. Here 1,000 went to 940. Do you realize is a loss for Mr. A? But students, that part has been ignored by the solution in ICAI. The second mistake is, when the PNL for XYZ was calculated, they forgot to take one more outflow. Anyone understands which outflow? The dividend. The dividend that XYZ had to give to Mr. A, the dividend XYZ only has to give, right? That dividend outflow has been ignored. It's wrong. There is no logic of ignoring it. It should have been taken into consideration. But anyways, this is your solution as of now. Even in the May 22 RTP, same solution was taken. So please stick to this only. Everyone clear? So with that, students, we complete the discussion to question number 11. Okay friends, so now let's do question 12, which is from mergers and acquisitions. Students, this particular question is again a routine question of M&A. I'll just pull out my video in which I've discussed in a batch a very similar question. Watch it and then this question also will be done. So welcome to one more question, question 29, on this concept of growth rate of earnings and dividends of the Target Limited changing under the new management of acquiring company. One more question, one last question just for your practice. We'll do it together only. I'll not give it to you as a test. Don't worry. Students, question 29, I request everyone to please pause the video and read the question carefully. Start. Okay friends, I hope you all read the question. Let us now try to understand this. See, as finance director of BM Limited, you are analyzing the planned acquisition of WA Limited. So BM becomes the acquiring, WA becomes a target. Following data is available to you: acquiring company, target company. They are given to you the expected EPS, expected dividend per share, which means this is straight away D1, students, number of shares, and then current market price per share. Then they say your estimate indicates expected steady growth of earnings and dividends to the tune of 6% per year. So the acquiring company, as it is analyzing the target company, it comes to know according to its analysis and estimates that the growth rate will be 6% per year. However, under our new management, the growth rate is likely to go up to 8% per year without additional investment. I hope you understood. Calculate. Let's do one by one. Point number one, the cost of acquisition by BM Limited, if rupees 50 is paid for each share of WA, PC is paid in cash. Students, nothing much to do. It is nothing but, see, cost of acquisition means cost of merger is nothing but cash paid to the shareholders of Target Limited minus the pre-merger market value of Target Limited. Everybody following? Let us knock off point number one. I'll write down your question 29. In that point number one, calculation of cost of merger. Tell me, students, what is the formula of cost of merger? It is nothing but cash paid to shareholders of Target Limited by acquiring Limited, obviously, minus the pre-merger market cap of Target Limited. Everybody following? Minus the pre-merger market cap of Target Limited. Tell me how much cash you are paying. They are saying per share we are paying rupees 50 cash. How many shares are there in the Target Limited? Number of shares, students, are 12 lakh. So can I say the cash being paid is 12 lakh into 50 minus their pre-merger market cap will be their pre-merger number of equity shares outstanding, that is 12 lakh, into the pre-merger market price per share. The pre-merger market price per share, students, given to you in the question is rupees 40. So basically 12 lakh into 50 minus 12 lakh into 40 is nothing but 12 lakh into 10. The cost of merger is nothing but 120 lakh rupees. Everybody following till here? Very good. Let's go to the next point. Point number two. This point number one is done. Now point number two, they are again asking you cost of merger, but now if one share of BM for every 3 shares of WA is the agreed exchange ratio. The share exchange ratio, students, is 1:3. Can we start? So I'll write down here. Point number two, again they're asking us calculation of cost of merger when the share exchange ratio is 1:3. Everybody following? Share exchange ratio is how much? 1:3. For every 3 shares of Target, acquiring will be offering 1 of its own shares. Tell me, students, in this case, what is the formula of COM? Please pay attention. Cost of merger, you know it, right? It is number of equity shares issued to shareholders of Target Limited, obviously by acquiring Limited, into the post-merger market price per share, the whole minus pre-merger market cap of Target Limited. Everybody following? We all know that the pre-merger market cap of Target Limited is nothing but 12 lakh into 40. I'll write down here 12 lakh into 40. Now the only thing we need to know is this bracket. Can we start? First of all, let's focus on the number of equity shares. 1:3 is the ratio. There, how many shares are outstanding, students? There are 12 lakh shares are outstanding. Can I say the number of shares we will be offering to the shareholders of Target Limited will be 12 lakh into 1/3. Everybody clear? So students, 12 lakh into 1/3 will be the number of equity shares issued by A Limited to the shareholders of Target Limited. Everybody following? Now the most important hero is coming for post-merger MPS. I have been teaching you. There have been 2 alternate assumptions. One is the P route, one is the market cap route. Tell me, which route will you take? I have told you clearly in almost 2 to 3 videos earlier that whenever there is this growth rate change, always go for the post-merger market cap route, because in that only you will be able to embed the change in the market values due to the change in the growth rate of Target Limited's earnings under the management of acquiring company. Everybody following? So let us now focus on the post-merger MPS. If we are going for the market cap route, can I say post-merger MPS is nothing but post-merger market cap upon post-merger number of equity shares. Okay, post-merger market cap upon post-merger number of equity shares. First of all, let us knock off the post-merger number of equity shares. Tell me, students, in the acquiring company already how many shares are there? 20 lakh shares are already there. So I'll write down here 20 lakh shares. They will continue post merger also. Yes, and for taking our target company, how many shares we are issuing? 12 lakh into 1 by 3, that is nothing but 4 lakh shares. So plus 4 lakh shares we are issuing. So the post merger number of equity shares will be 24 lakhs. Everybody following till here? Now the post merger market cap. Can I say post merger market cap is nothing but the summation of the pre-merger market caps of A and T. The pre-merger market cap of acquiring company, students, is, can I say, 20 lakh shares into 180. That is the current market price. So I'll write down here 20 lakh into 180. Are you listening? Plus, students, as far as the target company which comes into our acquiring company, what are their existing number of equity shares? 12 lakhs. And what is the market price per share? 40. So I would want to write here 12 lakh into 40. But I'm very sure you all understand this 40 is wrong, because this 40 is under the assumption that their current existing growth rate will continue as it is. But do you realize, as they come inside our company under our management, their growth rate of earnings is going to increase, and therefore this 40 will swell up, their 40 will go up, the market price will change, as we have been seeing in the previous videos also. Everybody following? So I'll not write 40 here, it will be 12 lakh into something else. Can we start? So let us now calculate the revised pre-merger MPS of Target Limited entering into the acquiring company under its new management. Can we start? So students, I'll write down here calculation of revised MPS of Target Limited. Okay, calculation of revised MPS of Target Limited. First of all, tell me its existing data. Can I say in the existing data, I will like to tell you that the D1 is 1.6 of Target Limited, obviously. So D1 equal to 1.6. Next, students, they have given to us the growth rate. The growth rate currently, students, is 6% per year. So I'll write down here 6%. And as far as P0 is concerned, the P0 given to you, students, is rupees 40. I'll write down here 40. And with this, students, we can easily find the KE for this company, Target Limited. So the KE, students, is nothing but D1 upon P0 plus G. It is 1.60 upon 40 plus 6%. On the calci, 1.6 divided by 40% plus 6, we get a KE of 10%. Everybody following? 10% therefore becomes the KE for this Target Limited. Let us now calculate the revised MPS. Students, for revised MPS, do you realize that my KE will remain at 10%, my D1 will remain at 1.6%, but my growth rate now will change from 6% to 8%. I'll show you where they have given to you. They are saying, however, under the new management, the growth rate is likely to go up to 8%. So students, here the growth rate is 8%. Can I say the P0, the value of equity, will be D1 upon KE minus G. Let us put the numbers now. Can I say it is 1.60 upon 10% minus 8%. Students, 1.6 divided by 2% gives us a value of equity, market price per share of the Target Limited entering into acquiring limited as rupees 80. So we now have the market price of the target company, students, as rupees 80 entering into the acquiring company's overall world. Students, earlier it was a company with a share price worth rupees 40. Had it continued to remain separate, its share price would have still continue to remain 40, but because it is now coming under the new management, this company, which was earlier worth 12 lakh into 40, under the new management of acquiring company, it is worth 12 lakh into 80 now, because the growth rate is now changing. Everybody following? So with this, we can easily find out the post-merger market price per share. Can we start? So on the calci, 20 into 180 M plus, 12 into 80 M plus, MRC divided by 24, I get the post-merger market price per share as rupees 190, which, students, I hope you understand, I will post here to find the cost of merger. Can we start? So therefore, students, 4 lakh into 190 is what the shareholders of target company are receiving as wealth by giving up 12 lakh into 40 worth pre-merger company of Target Limited. Let's see what is their cost of merger. 4 lakh into 190 M plus 12 lakh into 40 M minus MRC, I get the cost of merger as 210 80 lakhs. Everybody following? So with that we complete point number 2 also. They asked us the cost of acquisition, cost of merger. We are done with it. Point number 3, they are saying compute the gain from acquisition. Students, they are not talking for gain of shareholders. They're just generally saying gain from acquisition. I will tell you what to do. Students, do you realize that in this particular company, post-merger number of equity shares are 24 lakh, correct? 24 lakh and the market price per share is 190. 24 lakh into 190 will give you the overall market cap of the post-merger firm. That is nothing but this numerator here. Everybody following? So I'll write down here post-merger market cap. Okay, please pay attention. This is point number 3. Post-merger market cap, can I say, is 24 lakh into 190 rupees per share. So 24 into 190, if I do, 4,560 lakh rupees is the market cap of the post-merged firm. Everybody following? Students, tell me, as far as acquiring company is concerned, what was their pre-merger market cap? The pre-merger market cap of acquiring company is nothing but 20 lakh shares into 180, that is 3,600 lakh. So 3,600 lakh is the pre-merger market cap of A Limited. I'll write down here 3,600 lakh. As far as T Limited is concerned, the Target Limited is concerned, their pre-merger market cap is what? Their pre-merger market cap, we all know, so many times we have seen, it is 12 lakh into 40. Yes, I'll write down here 12 lakh into 40, that is nothing but 480 lakhs. So can you see, students, a company worth 3,600 lakh and a company worth 480 lakh, when they come together, they form a company worth 4,560 lakh. The gain on acquisition therefore is 4,560 lakh minus 3,600 minus 480. Can I say there is a gain of rupees 480 lakhs on acquisition? Everybody following? And this is obviously happening only because of one reason. You know the reason. I'll tell you again, that reason is nothing but a 12 lakh into 40 worth company is now swelling up to 12 lakh into 80 worth company. There is an increase of 12 lakh into 40. That is nothing but this increase of 480 lakhs. Everybody following? Now the last part, students, point number 4. This is cakewalk. They are saying if the expected growth rate continues to be 6%, how the new share price as well as cost will be different. Let's quickly complete this. Basically, they are now saying that the growth rate will not change. If the growth rate will not change, do you realize, students, this T Limited which enters into A Limited will now not enter as a company of 12 lakh into 80. It will continue to be a 12 lakh into 40 worth company, and therefore you have to recalculate everything. Let's quickly complete this, students. So they are asking us, what if the growth rate remains normal? Do you realize that my post-merger, this is point number 4, okay? Post-merger market price per share is nothing but post-merger market cap upon post-merger number of equity shares. Post-merger number of equity shares we already have is 24 lakh. Post-merger market cap is nothing but now the sum of pre-merger market caps of A and T. Pre-merger market cap of A, students, is 3,600 lakh. Pre-merger market cap of T is 480 lakh, students. That's it. This 40 only will take now, not 80, because the growth rate is not changing. So students, 3,600 plus 480. Yes, so basically what is happening, that since the growth rate of the Target Limited is not changing under the new management of A Limited, the post-merger market cap of A Limited will be its existing pre-merger market cap plus the normal pre-merger market cap of Target Limited. There isn't any kind of increase, appreciation in the value of Target Limited as it comes into acquiring company, because the growth rate is expected to be same. So straight away 12 lakhs, its pre-merger number of equity shares into its pre-merger existing market price per share, 480 lakhs worth company enters into our company. Therefore the post-merger market cap is nothing but the normal sum of pre-merger market caps. So 3,600 plus 480 will give us 4,080 as the post-merger market cap divided by 24 lakhs. I get the post-merger MPS as rupees 170. Everybody following? As rupees 170. So they were asking us what? They were asking us the new share price. We got the new share price post-merger as rupees 170. Yes, and they're also asking us the revised cost of merger. Let's quickly knock this off. Can I say revised cost of merger will be number of equity shares issued to these people, the shareholders of Target Limited. We know 1:3 is the ratio. Therefore, for 12 lakh shares, 4 lakh shares we are offering. So students, 4 lakh shares we are offering into post-merger MPS is 170. I hope you understand. The whole minus the pre-merger market cap of T Limited, that is 480 lakhs. Let's take the calci and solve this. 4 into 170 M plus 480 M minus MRC. The cost of merger now is rupees 200 lakhs. Everybody following? The cost of merger comes to rupees 200 lakhs. Earlier the cost of merger had come to how much, students? Earlier the cost of merger had come to 280 lakhs, but now the cost of merger is only rupees 200 lakhs. Everybody following? This is nothing but the basic calculation of cost of merger we are doing. If the growth rate would have remained constant, if the growth rate would have changed, the post-merger MPS would have changed. Everything else will remain same only, right? So with that, students, we complete point number 4. I hope you understood this question 29 and also this module of impact of growth rate change. Everybody clear? So I will now flash the solution of this question on your screens. You can pause the video and copy down the notes. Okay, students, so now we come to the last question, that is question number 13. Now disclaimer. Students, this question is based on the concept of adjusted present value. Now, many of you might not be knowing what this concept is. So what I have done is, in the description of this particular video on YouTube, I am attaching another YouTube link in which I have discussed in great detail what adjusted present value concept is all about. Once you have seen it, then only please see this question 13, because in this question, in this RTP video, I will not be able to gather the time to explain what adjusted present value is. So you please first watch that video and then come here, okay? Alright, so I'll start question 13. The management of this company is engaged in the construction of an infrastructure project. A proposal to construct a toll road in Nepal is under consideration. So they are saying the initial investment will be $250 lakh. This is your II. Economic life 10 years. Now I'll just mark this 10 years, okay? The depreciation on the equipment will be charged on straight line method. Very good. EBITDA, which means earnings before interest, depreciation, tax and amortization, is 33 lakh per annum for a period of 20 years. Okay. Now, they are saying to encourage investment, Nepalese government is offering 15-year, okay, 15-year term loan of $150 lakh at an interest rate of 6% per annum, interest to be paid annually. Loan will be repaid at the end of 15 year in one tranche, which means you have to keep paying interest every year. Normally no principal repayment for 15 years. At the end of 15th year, one tranche means one shot you can repay, or you have to repay the 150 lakh loan. The required rate of return for the project under all equity financing is 12%. Post-tax cost of debt is 5.6%. Tax rate is 30%. Can I say, students, the pre-tax cost of debt, or basically the pre-tax interest rate generally for this company will be 5.6% divided by 1 minus 0.3, correct? Whenever you want to convert anything to pre-tax, you divide by 1 minus t, and this comes to, students, 8%. All cash flows will be in dollar. You are required to advise the management on the viability of the proposal by using the adjusted present value or net present value concept. Everyone clear? This is a new method for all of you. Ignore inflation, okay? Note, make calculations in USD and round off them up to 3 decimal points. Okay, students, so let's now start the solution. First of all, as you have already seen in my video on adjusted present value, we have to ignore that there is any loan and just solve it as if it is a purely all equity financed company or a project, correct? Now, if it's an all equity financed project, Then students, what will be the CFAT, cash flows after tax? Let's start with this. Now, within this students, there is one problem. Do you understand that you will be getting this EBIT for the next 20 years? However, the depreciation that you will be taking and enjoying the tax benefit for, do you realize will only be for a period of 10 years. Hence, can I say that when we do the calculation of CFAT, we will do 1 to 10 years separately and 11 to 20 years separately. Everyone clear? Another option is you do CFAT calculation for 20 years non-stop full on without even thinking about depreciation for full 20 years and do not take depreciation into consideration and take the 10-year depreciation tax shield separately. That's how ICAI does it. But I will do it in two parts of CFAT. One is considering depreciation for the first 10 years, another is not considering depreciation for the next 10 years. So if you can see here, step 1, calculation of base NPV, assuming entire project is funded by equity. In that I am first calculating CFAT. So let's talk first 10 years. 33 lakh is the EBITDA. 250 lakh initial investment minus no salvage given divided by 10 years depreciation, EBT. Correct? Sir, from EBIT you are subtracting depreciation, that D you are subtracting. Amortization is not there in the question. Okay, I understand. So these two gone. But sir, interest, where is the interest subtraction? Students, as I said, we are solving it as if the project is funded by equity. That's the whole point of adjusted present value concept. Okay. So EBT minus tax, NPAT plus depreciation, CFAT. Simple. And when you see 11 to 20, same 33 lakh I have taken, but I have ignored depreciation here because the machine is only for 10 years. So last 10 years, so the next 10 years this depreciation won't come. And then normal calculation, we reached CFAT, and then students we went on to calculate normal NPV, initial investment 250 lakhs, first 10 year CFAT, next 10 year CFAT. Now 12%, this rate from where I took, I'll tell you this. Required return for the project under all equity financing is 12%. So at the rate 12% calculation I did, and I got the NPV, the base NPV as 35.091 lakh negative. And then as you all have seen in my video, how to calculate adjusted present value, it will be the base NPV, that is all equity funded, plus whatever tax shield you are going to get or tax benefit you are going to get due to interest, the present value of that. Now students, as you know, the interest will be 150 lakh into 6%. So here we are doing 150 lakh into 6%. On this interest, the tax benefit you will be getting is 30% every year. For how many years? This also year is different, for 15 years only. So can I say 150 lakh debt into interest rate? This is the interest into 30%. This is the tax saved. This is the tax saved per annum. I want to calculate present value. So can I say I will then multiply the 2.7 lakh by the annuity factor for 15 years. And which rate to take? As we have already discussed, the pre-tax cost of debt has to be taken into consideration, discussed in that adjusted present value video. Correct? The pre-tax cost of debt, do you realize 5.6% they gave you post-tax. I converted it to pre-tax. And then at this rate for 15 years, all these numbers, by the way, all these numbers students, the annuity factors are given in the question only, if you can see. Right? RTP here, all these numbers are given here. Okay, from here only I have taken these numbers. The present value will be 2.7 lakh into 8.559, total combined cumulative present value for 15 years. That plus the base NPV will give you the adjusted NPV. ICAI is saying since adjusted present value is negative, this company should not accept the project. So everyone clear? So with that students, we finish the discussion to this RTP of November 24 AFM. There are 2-3 theory questions also which you can self-read. I hope you understood this entire RTP. Thank you very much. All the best for your exams.